Morning, everybody. It is Monday, January 29th, 7:33 a.m., and we are back for another market open. This one is an earlier market open than usual. Usually we start here at 8:45 on the channel. Today we are here at 7:30, and the reason we are here at 7:30 is because we got a SoFi call to go through, and we got to go to a SoFi earnings to discuss. SoFi is out with their Q4 earnings. They have absolutely smashed these earnings, and it's really, really, really excited to look at just in terms of observing how they've guided, what they've said they're going to do, and how the street is initially reacting to some of these numbers. This is a high-level overview of what we got on SoFi earnings, and then we'll get started and get into everything. Q4 revenue, $615 million, up 33% year over year. 585,000 new members, up 44% year over year. 2.9 billion in deposits, 18 billion over the year, and $48 million in GAAP profits for SoFi. Those are not just adjusted profits. It's not adjusted EBITDA. It is GAAP profits, and the street likes it. SoFi right now is at $8.39. The screenshot I put here on Twitter was at $8.20. So we are up about 10% right now in the pre-markets. And it's really exciting seeing SoFi get this level of momentum. There is nothing that I've seen in the numbers, and we're about to go through all of the deeper numbers right now, that would signal anything necessarily bearish or that would signal anything at, like a sell-off that's coming. I mean, last quarter also, you could say with the triple beat, there shouldn't have been a sell-off, but we were at the pretty much bottom of the macro cycle in terms of, if you guys remember, October 31st was just a really tough time for the market 2022. And then November, December, picked up, and then SoFi actually went up about 10-15% in those 2 months, having come back down about 20% since then. But nothing in these numbers kind of shows that the street should be upset. And we're going to go through all these numbers one by one. And given the pre-market action we're seeing from the stock, I don't think this is going to be the worst report for SoFi, at least from a stock perspective, because from a numbers perspective, on just a pure fundamental basis for their company's results in Q4, things are good. Things are pretty good. And I wouldn't imagine that things are that bad. Gino, Franz Baker, Harry Wild, Swada, Alex, Monty, Jesse, Rock and Ronnie, Sam Chan, Justin Bryant, Iceman J, Oak, Wes, Alex, Imnop, June, Lawrence, Justin Bryant, Ricardo, Midwest, Dale. Thank you all for being here. Mental Training Channel, Benny. Benny says, I will probably be selling if it hits 10 again. As we all know, it's going to be coming back down to 7 in no time. And I think that's the existential question. If it does moon in the pre-markets, which I think it can, or as soon as the bell opens, right? Which I think we can see that Q2 2023 type of move back in July, where it went up to 1130. Is that possible? Anything's possible today, I think, given these numbers. Does it just get sold off? And I think that's the broader question that all of us are going to be trying to figure out. And we'll see what happens. Jimbo Slice, Brown Group Inc., Duvenson, June, John Davis. P says, first time watching you live in the morning. Not happy about it since it's 4:30 a.m. in California. Thank you for being here. We got a lot to discuss. And today's going to be the market open. We'll be streaming the call at 8 a.m. That's when Noto will be talking. And I think it'll be done by about 9. So we'll have a good hour to do the actual market open from like 9 to 9:30. We'll be able to discuss the variety of geopolitical events that are going on, which are not necessarily the best if you aren't a fan of war, because the United States looks like we're about to get into another war. So we got to talk about that. We have a ton of macro stuff this week. By the way, guys, little announcement. Mr. Dan Ives will be joining the channel at 5 p.m. today, Eastern Standard Time. And he'll be recapping Tesla earnings with me and discussing Microsoft and Amazon, and Apple. Those are the two main companies he's looking at to recap for the week. It should go down. He's a very busy guy. His schedule is always moving, but he confirmed yesterday 5 p.m. So as long as he is good to go 5 p.m., he'll be here live, and he'll be discussing everything that happened in the world of Tesla and discussing Microsoft and Apple. We also have Meta earnings this week. We have Apple earnings this week. We have Amazon earnings this week. I mean, we just have a lot of stuff to discuss this week. This is going to be one of the busiest weeks, I think, of my year, quite frankly. This is a busy week, even all the macro political stuff. We have FOMC is happening this week. We have Jolt's report coming out. I mean, there's just a ton of stuff happening this week. So this is an exciting week to be an investor in the stock market, and it's going to be fun just going through everything we need to go through to analyze what's happening. Also, not to be, too much of a party pooper here, but February tends to be the worst month for tech stocks historically. QQQ is at an all-time high. February historically tends to be a pullback month for tech stocks. I would imagine that, given we're at all-time highs on the Qs, maybe things can get choppy. Now, if the big tech companies perform the way they need to perform and they justify these valuations, somehow Microsoft has to justify $3 trillion bucks, then we're going to be in a good spot. But if not, then, we'll see what ends up happening in February. So it'll be a very interesting month to kind of analyze what's going on. And I would definitely keep some dry powder on the side because, it's better to buy Amazon at 130 than at 150 if we get there. So we'll see what happens. All right, here we go. SoFi earnings, 585,000 members. This is a decrease from last quarter at 717,000, but I think we knew that the street was, or at least that SoFi was not going to be able to pull up another 700,000 quarter member. And there's two things about it. They probably could get to that 700,000 if they wanted to, but the issue is they wouldn't have been gap profitable, right? And so, at some point you have to sacrifice profitability for growth or growth for profitability. And it seems like, well, they're still growing 44% year over year in terms of members, 7.5 million members now. So why don't we get, less members and more profits and then figure out how to scale profitably over time? But so that 717 number was really good for them because it was an anomaly in terms of new member quota growth, but it was enough for them to keep moving on from there and keep it going. Peace Chess, thank you for the $5 super chat, courtesy of Anthony Noto. Thank you, Peace Chess. I really appreciate that. $4.99 means a lot to me. Thank you for that super chat. Okay, products. New product additions of 695 million in Q4, bringing their total to 11.1 million, which is 41% year over year. The tech version of the company or the tech product that the company offers is guiding for 50% year over year growth. So we'll talk about that in a second. But this is really nice to see that new product additions were 695 million in Q4, 695,000. Sorry, that brings it to 11.1 million, which is up 41% year over year. And that's just the amount of, people that are actually signing up to use different products. They have lending products. They obviously have loans in the context of automotive loans, home loans. They obviously have the tech products, everything that major big companies use from the AWS fintech side. So there's a variety of different, products that SoFi offers. And in this case, that was 695,000. That M was supposed to be a K. So they made a little mistake there. That M should have been K. Okay. Galileo counts. This is their AWS of fintech. 145 million, 11% year over year. So that's nice because there's a little bit more growth there than we saw from before. Q4 2022, year over year growth was at 31%. That year over year growth has declined to about 11%, but at least it's getting to higher levels. That 131 to 126 dip that we saw going into Q1 of 2023, that was something that was a little bit of a downward trend back to an upward trend. And it is growing at a rate that is higher than it was last quarter, back to Q2 growth rates at 11% year over year. Now, again, Galileo, it's good that Galileo is growing, but the revenue portion of the tech business, which is Galileo and Technesis, that's what their guidance was really exciting about in terms of 50% year over year growth. And I think that's why the street is also excited, because if 50% of revenues in 2024 are going to be from the tech product, and the tech product is now becoming a real SaaS business, there might be a SaaS multiple that the street has to think a little bit about it. And if the street has to think a little bit more about that SaaS multiple, maybe we see more multiple expansion from the street as well. Lending products up 24% year over year to 1.6 million. SoFi is up 10% of the pre-markets. That's correct. Financial service products up 45% year over year to 9.4 million. This is their entire loop, what Anthony Noto calls kind of their feedback loops, their network effects that allow them to continue to grow. So they have a graphic there. And then here we go. Okay, so quarterly net adjusted revenue of 594 million, 34% year over year. It's 615 million top line, 181 million quarterly adjusted EBITDA. Wow, look at that jump. Last quarter was 98 million. This quarter it's 181 million. And there's a 30% margin on that bad boy. Wow, the margin was sub 20% for the past 5 quarters. Wow, that's interesting. That's actually very exciting. That number, that right there, and the guidance, forget the gap profits. That an EBITDA margin and the guidance has got the street excited. I think got the street even more excited than the gap profits. 2023, they did $2.7 billion and $2.074 billion in revenue, 35% year over year growth. Adjusted annual EBITDA, 432 million. That's up 21% year over year. That's amazing as well. And then where is their guidance? All right. So this is full year 2023. Okay. So on the low side, they're assuming so this is a comparison. They beat the low estimates of 2.05 billion and the high estimates of 2.065 billion by 2.074 billion. They also beat their 386 and 396 EBITDA. So they're basically saying, hey, we beat on adjusted net revenue and we beat on adjusted EBITDA. Q1 2024, we expect to deliver 550 to 560 million in adjusted net revenue and 10 to 20 million in GAAP net income. Interesting. Okay, so on the low side, they think 550 and 10 on revenue and profits. On the high side, 560 and 20. You know, that's really interesting. They brought in 48 million in profits this quarter. So I definitely want to see why they had more profits this quarter than what they're expecting for the consecutive quarters. Okay, so here's the big thing that I think has the street happy. Tech platform and financial services growth of 50% or more. When you're a tech company and you guide for 50% year-over-year growth, the street gets excited. The street gets very, very excited. And so I think we're seeing some broader momentum there from the street just saying, okay, you know, if this is what you're going to give us, then we're going to take that seriously. If you're actually going to be able to grow at 50% year over year, especially when the tech business just hasn't been, you know, that strong in terms of contributing to their overall revenue. So that's amazing. Adjusted EBITDA of 580 to 595 million, GAAP net income of 95 to 105 million. So that means about 20 million a quarter. They're guiding of GAAP net profits. So 105 million for the year, which is not crazy. You know, I think the street is excited about that. Lending segment at 92 to 95% of 2023 revenue levels. A lot of that is going to happen because of the student loan business as well. That's going to start kicking up. And because that's going to start kicking up, that's going to get the street super, super excited that it's going to come back to, you know, the levels that they've missed. And then you got EPS of 7 or 8 cents a share. All right, look, that's not bad. That's not bad at all. That's to imagine you get back to 95% of 2023 revenue levels in the context of lending segment and 50% growth from 2023 levels on the financial services product. That's very exciting, dude. That's pretty damn excited in the context of what SoFi can offer, how they're going to be able to grow, and where the company can end up. Let's go to the stock real quick and just look at how the stock's doing. Right now, 844 in the pre-markets. We got Noto talking about 15 minutes. Oh, I'm not showing that. Let me show the stock. 844. It's up 10.76%. Now, Q2 2023, which was the best earnings call for SoFi in terms of its stock price action. We got Bitcoin, by the way, at 42,000 as well. We had SoFi balloon to around like 950, 920 in the pre-markets. And then we saw the momentum after that to 11, and then it fell to 8 over the coming days. But it did sustain that $11-10 range for at least a week. I'm very curious how the street thinks of it right here. JP Morgan put out a report this morning that we'll talk about in a second. It was a pretty bearish report. It was actually last night they put out this report, and they said SoFi has a ton of headwinds. They're going to be in a ton of problems, blah, 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 blah. And it was weird because it was like they were trying to put some last minute report out to tank the stock. I think SoFi pretty much proved against expectations that they're fine, they're doing well, and that they're winning. And if they are, you know, going against kind of what JP Morgan said, then it looks like the market is also really excited about that as well. Here's what JP Morgan put out last night on SoFi. They said they're looking at investor conferences from November when SoFi was talking about how in a higher interest rate environment, it would be tougher for them to sell loans. They reduced their 2024 estimate. So they said that our 2024 EBITDA estimate goes to 560 million from 626 million versus the street at 602 million. And that's offset by potentially the tech platform. SoFi on their... Okay, so SoFi is only showing adjusted EBITDA of 580 to 590 million. The street... Oh, yeah, so that's better. So SoFi saying we're going to grow at 580 million adjusted EBITDA, and JP Morgan said they're going to grow at 516. So that's another reason the street, I think, is giving it the premium, because JP Morgan said last night at like 11 p.m., hey, SoFi is not going to grow that much. Here's XYZ reasons why. And SoFi said, no, we're growing 70 million more than what you guys thought you were going to grow. It was a really weird thing for that to come out randomly. I mean, it's you could imagine that it was on purpose for them to put that out, but you usually don't put that out before earnings, without a reason. JP Morgan is a competitor. That's 100% correct. All these banks are big competitors to SoFi. And although SoFi is not taking, JP Morgan's lunch or anything like that, it's still something that they think about, given what if one day, these guys get a little bit bigger. Early pre-market pre-earnings was already up 5.5%, definitely a leak. Yeah, in the after hours trading, Robinhood had about 700,000 shares traded of SoFi, and it was up 5% before, we even got into the numbers today. So it seemed like the street was definitely excited about something, and they just didn't know what exactly. Let's go to their actual press release, and let's read some quotes from Noto, see what he's saying, and then we will keep going from there. Okay, so we delivered another quarter of record financial results and generated our 11th consecutive quarter of record adjusted net revenue of $594 million. We saw net new member adds of 585,000 and growth for a 44%. Total for period-old members, 7.5 million members. Record revenue at the company level was the record revenue across all three of our business segments, with a record contribution of 40% of adjusted net revenue generated by our non-lending segments. That's financial and tech services, which are really, really good. That's the stuff that the street really wants to see. Okay, so they just went through their numbers here. Nothing too crazy. They generated $240 million in tangible book value in the quarter and $334 million for all of 2023. What is their customer acquisition cost? Do they have that here? I want to see how much that went down or up. I'm really curious to see that one. That one I think we can find really easily from the numbers. Okay, yeah, Noto's just saying the numbers. He's not saying anything qualitative. So let's see. Let's see if we can. Oh, sales and marketing. That's what we're looking for. Okay, here we go. Sales and marketing. So Q4 2023. Wow, they spent the same. They spent the same as they did. They spent even more. So in 2022, they spent $617 million on marketing. 2023, they spent $719 million, almost $800 million on marketing. Last quarter, they spent $1 million more than they spent a year ago. 2022, they spent $173. This year, they spent $174. So they produced GAAP profits by still spending a crap ton on marketing. Again, for SoFi, they spend, I think, on average, like $300 on a customer to get them in, and they make it up on the back end, but they do have to pay a pretty penny to get that customer to come in. So they spent $174 million this quarter. I think last quarter was a little bit more or the same. It wasn't that different. Interesting. So that was their cost. Erwin, good morning. Thank you for being here. RDL Tan says, thank you, Mitt, for the stream. Didn't catch what you said earlier. How long did SoFi run up, top out before prices fell in Q2 2023? So in July, earnings came in and the stock went from, I think, 10 to 11.30 on the day. But in pre-markets, it was at like 9 or 8.90 the whole time, right? So it was never at the levels we were at right now. Like right now we're at 8.35. We were barely there, right? We were at mainly $9 hovering there at the same time. And then when the market went live, SoFi came up to 11.30. That's when I was up $30,000 on my SoFi calls. And I didn't, thank you for RDL for making me clarify on these comments, because it definitely makes me remember certain things. But yeah, that's when I was up a lot of money and I didn't sell. But that's so we were at 11.30, and then within the coming days, we definitely got to like 10. I think that night we ended at 10, and then over a series of about a week or two, the stock started hovering in that 9 range. So it came down from 10. Then it was 8.70 to 9, 8.80 to 9.20, and then by the August kind of rundown we had in the broader markets, and that was followed by a pretty bad September and October for equities. We were back at 6.30 at the bottom. So I don't think it's horrible at all for anyone to sell some shares today or sell some calls today. I have calls that I'll be selling today if they pop really well. I have my regular shares and that's there, but I have 60 call contracts on SoFi that I will definitely sell if we have a nice pop. That is my exit strategy. Sachin, also good friend of the channel. He has doing a trade on SoFi. Let me bring up his tweet. He's trying to look out to get out of here at 9. The thing about SoFi is it's hard for me to trust them deeply. Long-term shares you trust and you keep that in a portfolio. You never look at it and you're like, oh, all right, whatever. But on options, it's very hard to trust SoFi just because this stock does not, perform the way you want it to perform long-term. And so that's why it's a little tougher for SoFi. If you're in the options market, if you have shares, it's whatever. But if you're in options, it's a lot tougher to keep it up. So he said, looks like I will not lose money on the SoFi trade, may be able to make 50 to 200% depending on how the price lands after opening. And when options start trading, I would expect it to reach at least $9 today in the next 3 days. And that's likely my exit based on volume and momentum. I might hold it for a couple of days. So he's doing a lotto play. He's doing February 9th, 2024, $8 calls at 45 cents. That's what he bought them at. Break even's 8.45. Max loss is 45 cents a share. Yeah, if he gets that to $9, that would be a decent gain. My fear, and the way the stock's acting in the pre-market is kind of the issue I've had with SoFi stock is like, it's at 836. It's up 9%. That's great. The momentum needing to get it to like 10 or $11, definitely $10 is going to, I don't know. Maybe I'm underestimating it. I think it needs a lot of momentum on the upside. And the thing is, they're still 13% short. Okay. They're still 13% short. Actually, a little bit more, 13.6% as per last week. So the stock's 13.6% short. You would imagine that means the shorts might cover, given that SoFi is guiding for pure profitability, $100 million in profits. They're guiding for 50% financial tech growth, financial tech platform growth. And they're guiding for continued momentum at the tune of 40% top line revenue growth. If that's the case, if I was a short, like, I don't know what the thesis is to keep my short, unless you think the economy is going to be in a horrible situation. There is a massive recession coming. Jay Powell's not going to be cutting rates, which is going to be good for SoFi. It's not bad for SoFi. And there's this like economic, bubble that's happening right now. And that when it collapses, there's going to be massive levels of credit crunches and delinquencies. Like, unless you think that's the case, I don't know what's the reason to be short right now in SoFi. I really don't. And so I don't know. It's hard to imagine why they would be short, but if there is a squeeze, it would be based on that fact that there's enough revenue growth for the street to get excited and that the shorts have to cover. And that might get us, even if it's not a full squeeze, even if 1 or 2% of the shorts cover, that should put enough buying pressure to get us back to $10, I would imagine. Question is, if that really occurs. June says, I have a cost basis of 483, so not in a hurry to sell, but if it goes to 11, I'll be selling over half my shares. Yeah, I think that's a good plan. I think if you have options, today is the day to get some off the table because you just don't know where SoFi is going to go. And, you want to take profits when it pops. But if you have shares under $6, that's like, to me, that's golden averages. And you can leave that for years and not really worry too much. So we'll see. We got Anthony Noto speaking in 4 minutes. Let's take a look at where the rest of the market is, and then we'll get to whatever Noto is going to say. We got SoFi right now up 9.71%, Palantir 1640, Robinhood up 1084, up 0.46%, Bitcoin 42,000. Bitcoin had a nice little run over the weekend, 42,380. So it did really well, and it got back up from those 39,000 levels. So Bitcoin was doing nice. CleanSpark is up CleanSpark, in the pre-market's up 3.3. No, this is Friday's price. Sorry, 828. It's not trading on the pre-market yet. 3.37% right now for CleanSpark. NVIDIA is up in the pre-market, 614. SMCI is up right now. Let's look at Microsoft and Apple. Microsoft is up again in the pre-markets. Wow. It's up at 406. Man, Microsoft needs to crush earnings, dude. If Microsoft does not crush earnings, this AI narrative is going to take a little bit of a breather. Apple at 192. Meta at 395, up 0.34%. And then Google, where's Google at? Mag 7 is fine. Google's at 154. Look at that. We made a bunch of lists on Friday for those that were there on the Friday stream. So now we got oil and gas. We can look at it just as a sector. Boom. We got all the banks. You can look at all the banks right there. And so we're going to be able to go through a lot of these lists at 9:30 and see how the market's going. SaaS companies as well. You can kind of just look at everything and get a bird's eye view of what's happening. In terms of fintech, it looks like we're in a little bit more of a green day. Everything is green. Square, Coinbase, Affirm, PayPal, Robinhood, and SoFi. SoFi up 10.5% on the day. Now we got to see. Can what they say in the call get the street more excited to keep things going? I watched Dumb Money over the weekend. I liked it. A lot of people said they didn't like it. I liked it. I thought it was kind of cool. It got me down a rabbit hole, though, of consuming content from that GameStop era. Because, I mean, I remember that whole era, but, like, this weekend I, deep dived even more into what happened. And, Robinhood should not have taken off the buy button. That was especially because they didn't need to. They did it, in a precautionary way. Dude, I think they would have protected the brand so much if they just didn't do that shit. I don't really care. Like, the world has moved on. A lot of other brokerages did it. But the problem is everyone is buying GameStop on Robinhood. And when Robinhood takes off the buy button, I can understand if you had money in that stock and how your money evaporated. Even though you could still sell, I get it, but I can understand why you would be pissed off at Robinhood. Nonetheless, I think Robinhood's undervalued, so I don't really care. But it was definitely it was still better. Yeah, dude. I finally understand. Like after watching that movie and going back into it, I was like, oh yeah, this was not the right thing to do, especially because the way the movie made it seem, and maybe I'm wrong about this, they didn't need to do this. And then I listened to Vlad for like 5 interviews, watch him explain it. And dude, he did not have an answer. They were like, so why'd you do it? And he was like, well, blah, blah, blah. And I'm just like, can you just give me what? He's like, so you have a liquidity crisis. He's like, no, we don't have a liquidity problem. Like, I would have rather you said you had a liquidity problem and just be like, we had to do this. Cause then it's a straightforward answer versus this nonsense that Vlad was talking about for why they took off the buy button. It was just not good. It was not good. But things have changed since then. Robinhood stock has obviously fallen dramatically and I'm very bullish on it, but that just was not the best. Was not the best mood on Robinhood. It goes to show you big companies and startups, they can all definitely make mistakes and, things can happen. All right. So 30 seconds and see what SoFi has to say. But let's see. This call is going to be very, very important. Alex says Hood wasn't the only brokerage that did that. My Fidelity account wasn't letting me sell either. Well, they let you sell. You mean buy. If you mean buy, then yeah. And so that's the thing. Like that's what Vlad kept trying to say. He was like, no, well, we let people sell. So he's like, we weren't stopping you from making money. The problem is this was a revolutionary movement against Citadel and Melvin Capital. And the whole point was to keep buying, right? The whole point was to keep buying. I also went to Roaring Kitty's YouTube channel. Apparently his YouTube channel is still alive. I thought he ended it when he sold GameStop because he wanted to get rid of his brand, but all of his live streams from 2020 are still there. And I was like, huh, this is so interesting. It was so interesting to kind of see how we covered the whole thing and how we did it. All right. We should have SoFi coming up very soon, and then we should hear Noto and see what he has to say on earnings. We should have it in like 30 seconds, and we should be good. Bye. My bad. I'm driving. Alex, why are you typing while driving? Goodness. We need to. I hope it was a red light, even though I'm not going to lie. Dude, sometimes when I got to get a tweet out, I'll be whipping it on the highway. I'll start typing real quick. I'm not proud of it. I'm trying to stop. Sometimes you just kind of do a little typeroo on the phone. I got to stop. That's not a good thing. It's not a good thing. When I get to a red light, dude, I just get so bored. I have to have my phone on. I did that once with my mom in the car. She's like, why are you on your phone? I'm like, Mom, it's a red light. She was like, so? I was like, it's a red light. What am I supposed to do? Think about life? Like what? Pontificate? Like what am I going to do? All right, here we go. Earnings.
Good morning. My name is Daisy, and I'll be your conference operator today. At this time, I would like to welcome everyone to the SoFi Technologies Q4 2023 and full year 2023 earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, please press star followed by 2. Thank you. With that, you may begin your conference.
Thank you and good morning. Welcome to SoFi's fourth quarter and fiscal year 2023 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Christopher Lapointe, CFO. You can find the presentation accompanying our earnings release on the investor relations section of our website. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantage and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our subsequent filings made with the SEC, including our upcoming Form 10-K. Any forward-looking statements that we make on this call are based on assumptions as of today. We undertake no obligation to update these statements as a result of new information or future events. And now, I'd like to turn the call over to Anthony.
Thank you, and good morning, everyone. 2023 was a remarkable year for SoFi. We achieved multiple records and realized many of our aspirations despite seismic geopolitical and macroeconomic events. We demonstrated that we have built a business to thrive in a host of challenging environments reacting swiftly to change, driving our business forward with standout financial performance while continuing to serve our members' needs. Our 2023 results have reinforced my conviction in our long-term potential and our ability to achieve our aspiration to become a top 10 financial institution. I'd like to highlight some of our notable achievements for the year. We reached GAAP net income profitability in the fourth quarter and are positioned to continue to drive positive GAAP net income in 2024. We grew adjusted net revenue by 35% for the year to a record of $2.1 billion, while adjusted EBITDA of $432 million increased 200% versus 2022. This represents a 54% incremental margin and a 21% consolidated EBITDA margin for the full year, compared to our long-term margin target of 30%, which we achieved in the fourth quarter of 2023. Total members and products both grew over 40%, with 2.3 million new members in 2023 for a total of 7.5 million members. And we added 3.2 million new products for a total of 11 million products at year-end. We continue to diversify our revenue, with financial services and the tech platform contributing 40% of fourth quarter adjusted net revenue, up from 34% in the year-ago quarter. Our financial services segment achieved positive contribution profit in the third quarter, which ramped further in the fourth quarter. We completed a dramatic shift in tech platform's product offering and focus, positioning us to capture the massive opportunity in the traditional banking sector, in addition to tech and consumer companies looking to provide financial services. In lending, 72% of adjusted net revenue was from net interest income, compared to 48% in fiscal year 2022. Net interest income offers a more recurring and predictable cash revenue stream compared to non-interest income. We generated $334 million in tangible book value growth, which is now set to accelerate in 2024. Total deposits grew by $11.3 billion in 2023 to $18.6 billion, and over 90% of our consumer deposits are from direct deposit members. SoFi Bank reported net income of nearly $350 million, a 21% margin, with a return on tangible equity of 15.9% in its first full year of formation. To put some of these achievements in the context of a longer-term perspective, I'll note the following. When comparing our business to fiscal year 2018, which is when I joined SoFi and we embarked on our new strategy, we have grown annual adjusted net revenue by more than 8x, annual EBITDA by almost 3x, or $660 million, members by more than 11x, total products by 16x, and consolidated net interest income by nearly 5x. And since adding several financial services products in 2019, we have grown annual financial services revenue to more than $430 million, financial services products to 9.5 million in total, and financial services products now comprise 85% of our total products. The fourth quarter really capped an exceptional year. Record adjusted net revenue of $594 million accelerated to 34% year-over-year growth, while record adjusted EBITDA of $181 million grew 159%, with a 30% consolidated EBITDA margin. This EBITDA margin is up 14 percentage points year-over-year and is now equal to our long-term target of 30%. Financial services segment contribution profit grew to $25 million, an 18% margin, versus $3.3 million last quarter and negative $44 million in the year-ago quarter. Our deposits grew by a record of nearly $3 billion in the quarter. Tech platform segment revenue growth accelerated to 13% year-over-year, on its way to 20% next year, with a 32% contribution margin versus 20% in the year-ago quarter. In lending, 76% of adjusted net revenue was net interest income, up 43% year-over-year to $263 million. We point this out because $263 million in cash revenue is 2x greater than our directly attributable segment expenses of $120 million. Segment contribution margin improved by over 500 basis points sequentially to 65%. Company consolidated GAAP earnings per share was 2 cents, with GAAP net income totaling $48 million versus a $40 million loss in the year-ago quarter. SoFi Bank's net income of $129 million represents a 27% margin and an annualized return on equity of 16.8%. In terms of our balance sheet, we grew tangible book value for the sixth consecutive quarter by $204 million at the consolidated level, reaching $3.5 billion in total. Our total capital ratio improved to 15.3% from 14.5% last quarter, helped by organic tangible book growth, over $1 billion in loan sales, capital optimization moves, and an opportunistic convertible debt repurchase of $72 million. From a member and product perspective, in the fourth quarter, we added 585,000 new members for a total of over 7.5 million members and 695,000 new products for a total of over 11 million products. Now I'd like to spend some time touching on quarterly segment level results. Lending adjusted net revenue of $347 million grew 10% year-over-year against a difficult comparison of 51% year-over-year growth in the year-ago quarter. Personal loan originations grew 31% year-over-year to $3.2 billion. Student loan originations grew 95% year-over-year to $790 million, and home loan originations increased 193% year-over-year to $309 million. Within financial services, net revenue grew 115% year-over-year and 18% sequentially to $139 million, driven by continued strong monetization within the segment. We achieved $25 million in contribution profit despite our significant investment across money, credit card, and invest. As we noted last quarter, the credit card and invest businesses are still in heavy investment mode with losses of over $100 million annually on a run rate basis. Through unit economic optimization and greater scale, these businesses will eventually see positive contribution profit, similar to how we deliver with SoFi Money. We continue to see strong growth in SoFi Money products and, importantly, high-quality deposits and great levels of engagement. This has led to higher average account balances, even as average spend has increased. SoFi Money products have increased 54% year-over-year, or by nearly 1.2 million to 3.4 million accounts. As important is the quality of these members with a median FICO of 744 for a direct deposit portfolio, and hence we see ample opportunity for cross-buy. In terms of engagement, over 50% of our newly funded SoFi Money accounts are setting up direct deposit by day 30. This account primacy drives spending, which exceeded $1.5 billion in the fourth quarter debit transactions of volume. This is up nearly 3x year-over-year and represents more than $6 billion of annualized debit transaction volume. Our invest products, excluding crypto from all periods, grew 20% year-over-year to a total of 2.1 million, with AUM increasing 54% year-over-year. We've continued to launch exciting new products that meet our members' needs in financial services to further accelerate new member growth and cross-buy. Just today, for instance, we announced the launch of alternative investments and mutual funds. With the launch of alts, SoFi is granting yet another opportunity for everyday investors to access investment opportunities traditionally reserved for institutional investors and the ultra-wealthy. For our tech platform, revenue of $97 million accelerated to 13% growth year-over-year, up from 6% in Q3. We continue to make significant strides in our strategy of leveraging our unique product suite to pursue diversified growth and larger, more durable revenue opportunities. We started to see evidence of this strategy in the fourth quarter, as growth was driven not just by continued strong organic growth of existing partners and new product adoption by them, but also by notable contributions from increasingly diversified clients which have launched within the last 6 months. As mentioned last quarter, demand from traditional financial institutions and non-financial categories remains strong. While lead times for winning RFPs and ensuing integrations are measured in many quarters, not months, the transition to modern processing and modern cores is playing out in real time the way we envisioned it. On the product side, we continue to build and ship a diverse range of products for multiple sectors. Most notably, we launched an expense management solution in partnership with MasterCard that provides clients in the B2B sector with insights into corporate card spend. We launched same-day ACH, which allows account holders faster access to funds and helps mitigate risk tied to transactional delays. And we launched a risk data mart and data pipeline for our payments risk platform, which is seeing rapid adoption from existing clients. With that, let me turn it over to Chris for a review of the financials for the quarter and our 2024 outlook. I'll return to review our multi-year outlook after Chris shares his thoughts.
Thanks, Anthony. The Q4 and full year 2023 results really prove once again that our diversified and differentiated business model drives SoFi's durability and long-term growth potential. I'm going to walk through key financial highlights in our financial outlook. Unless otherwise stated, I'll be referring to adjusted results for the fourth quarter and full year of 2023 versus fourth quarter and full year of 2022. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-K filing, which will be made available next month. For the quarter, we delivered record adjusted net revenue of $594 million, with growth accelerating to 34% year-over-year and 12% sequentially from the third quarter's record of $531 million. Adjusted EBITDA was $181 million at a 30% margin, which is our long-term target margin, up over 80% from the prior record quarter of $98 million. This represented over 14 percentage points of year-over-year margin improvement and 12 percentage points of sequential margin improvement, demonstrating significant operating leverage across all functional expense lines. In fact, sales and marketing declined as a percentage of adjusted net revenue for the fifth consecutive quarter. Total operating expenses declined roughly 17 points as a percentage of adjusted net revenue year-over-year. Overall, this resulted in a 74% incremental adjusted EBITDA margin year-over-year. We achieved GAAP profitability this quarter for the first time, with GAAP net income reaching $48 million, an $88 million improvement year-over-year, and an incremental margin of 55%. We saw continued year-over-year leverage in stock-based compensation, dropping to 12% of adjusted net revenue versus 16% in the prior year period, on our path to our longer-term goal of single-digit stock-based compensation margins. For the full year, we delivered $2.1 billion of adjusted net revenue, up 35% year-over-year from $1.5 billion in 2022. Adjusted EBITDA rose 201% year-over-year to $432 million at a 21% adjusted EBITDA margin. Our full-year net loss was $54 million and 10 cents per share, excluding the goodwill impairment charge taken in Q3. We exceeded the high end of our most recent revenue and EBITDA guidance by $9 million and $36 million, respectively, by leveraging our unique suite of products and services, nimble asset and resource allocation, as well as a relentless focus on unit economics and risk management. Now on to the segment-level performance. In lending, fourth quarter adjusted net revenue grew 10% year-over-year to $347 million, with $226 million of contribution profit at a 65% margin, up from $209 million a year ago. These results were driven by 43% year-over-year growth in our net interest income, while non-interest income was down by 36%, primarily driven by increased losses and prepayments. Growth in net interest income was driven by an 82% year-over-year increase in average interest earning assets and a 122 basis point year-over-year increase in average yields. This resulted in an average net interest margin of 6.02% for the quarter, up 3 basis points sequentially and 8 basis points year-over-year. I'd also highlight our $2.9 billion of deposit growth in the quarter compared to the $1.6 billion of net loan growth on the balance sheet. The 218 basis points of cost savings between our deposits and our warehouse facilities has resulted in a meaningful benefit to our net interest margin. It also underscores the benefits of having the option of holding loans on balance sheet when advantageous and collecting net interest income. We expect to maintain a healthy net interest margin and benefit from the continued mix toward deposit funding, along with our demonstrated high loan WAC betas. On the non-interest income side, Q4 originations grew 45% year-over-year to $4.3 billion and were driven by growth across all three products, even as we continue tightening and underwriting against our stringent credit standards. We saw typical seasonality and intentionally planned for lower originations in our personal loans business, with originations of $3.2 billion, up 31% year-over-year and down 17% sequentially. Our student loans business saw origination volume nearly double year-over-year and declined 14% sequentially to $790 million. Home loans grew by 193% year-over-year and declined 13% sequentially to $309 million. Our personal loan borrowers' weighted average income is $171,000 with a weighted average FICO score of 744. Our student loan borrowers' weighted average income is $154,000 with a weighted average FICO of 781. Our Q4 on-balance sheet delinquency rates and charge-off rates continue as anticipated to normalize back toward pre-COVID levels. Our on-balance sheet 90-day personal loan delinquency rate was 56 basis points, while our annualized personal loan charge-off rate was 4.0%. Our on-balance sheet 90-day student loan delinquency rate was 13 basis points, while our annualized student loan charge-off rate was 59 basis points. We continue to expect healthy performance relative to broader industry levels. In the fourth quarter, we sold portions of our personal loan and home loan portfolios totaling $1.2 billion, approximately $875 million in personal loans principal and $350 million in home loan principal. In terms of the personal loan sales, we closed a previously disclosed $375 million securitization with BlackRock, where we sold both bonds and the resid at an execution level of 105.1% and closed an additional $500 million of loans in whole loan form to multiple parties at a blended execution of 105.6%. These had similar structures to other recent personal loan sales, with cash proceeds at par or at a premium to par, and the majority of the premium comprised of the contractual servicing fees that are capitalized. These deals included a small loss share provision that is above our base assumption of losses and immaterial relative to the exposure we would otherwise have had if we held the loans. In the quarter, we executed $450 million of senior secured financing, which will show up on our detailed balance sheet as senior secured loans held for investment at amortized cost. These loans have a fixed term structure and are secured against the underlying assets, therefore equivalent to investment grade bonds if you were to do a securitization for the same pool of collateral. In addition, these loans are priced at market rates, which not only helps to diversify our balance sheet, but also provides an additional return above our cost of funding and a yield similar to the net interest margin of our loans, which are unsecured. Now turning to our fair value marks and key assumptions. Our personal loans are marked at 104.9% as of the year end, up from 104.0% at the end of Q3. This was a function of the discount rate decreasing by 103 basis points, which was driven by the underlying benchmark rate declining by 90 basis points and spreads tightening by 13 basis points. Notably, the benchmark rate change and the spread change are empirical, as they are actual market observed inputs, not assumptions. Partially offsetting the decrease in discount rate was an increase in the annual default rate assumption from 4.6 to 4.8%, as well as an increase in the annual prepayment speed assumptions from 20 to 23%, which has an immaterial impact on the overall change in the mark. When a borrower prepays, we are still capturing the principal, and the impact to the value of the assets is only based on the premium above par at a given point in time, which is very small relative to the principal outstanding. We expect default rates to continue to normalize to pre-COVID life of loan loss levels of approximately 7 to 8%. For our student loan portfolio, the fair value mark at year end increased to 103.8% versus 101.5% at the end of Q3. This was a function of the portfolio WAC increasing by 24 basis points and the discount rate decreasing by 57 basis points, driven by the underlying benchmark rate declining by 86 basis points and spreads widening by 29 basis points. Partially offsetting the decrease in discount rate was an increase in the annual default rate assumption from 0.5 to 0.6%. Importantly, the fair value benefits resulting from interest rate decreases as well as personal loan spread tightening was offset nearly 1-for-1 by hedge losses and spread widening in our SLR business. So there was no net revenue benefit in the quarter due to discount rate input changes. For the full year, lending adjusted net revenue grew 21% to $1.3 billion, and the segment delivered $823 million of contribution profit at a 62% margin. Moving on to financial services, where net revenue of $139 million increased 115% year-over-year, with new all-time high revenue for SoFi Money, credit card, and lending as a service, as well as continued contributions from SoFi Invest. Overall monetization continues to improve, with annualized revenue per product of $59, up nearly 50% year-over-year versus $40 in Q4 2022, and up 10% sequentially. This is driven by higher deposits and member spending levels in SoFi Money, greater AUM and monetizable features in SoFi Invest, and robust growth within SoFi credit card spend. We reached 9.5 million financial services products in the quarter, which is up 45% year-over-year, with 626,000 new products in the quarter. We reached nearly 3.4 million products in SoFi Money, 2.4 million in SoFi Invest, and 3.3 million in Relay. Contribution profit reached $25 million for the quarter, even as we continue to invest aggressively against the ample opportunities to rapidly grow this operating segment with attractive returns. Full-year segment revenue of $437 million is 2.6 times the $168 million we delivered in 2022, and we broke even on a contribution basis for the full year. Shifting to our tech platform, where we delivered record net revenue of $97 million in the quarter, up 13% year-over-year and 8% sequentially. Annual revenue growth was driven by continued monetization of existing clients, along with new deals signed in new client segments. Galileo accounts grew 11% year-over-year to 145 million. The segment delivered a contribution profit of $31 million, representing a 32% margin. We continue to leverage investments made to integrate Galileo and Technisys and position the segment for higher rates of diversified, durable growth going forward. We expect tech platform revenue to continue accelerating in 2024 with strong margins. For the full year, the tech platform segment grew revenue 12% to $352 million and delivered $95 million of contribution profit at a 27% margin. Switching to our balance sheet, where we remain very well capitalized with ample cash and liquidity. In Q4, assets grew by $2.1 billion as a result of $1.6 billion growth in loans and approximately $400 million of growth in cash, cash equivalents, and investment securities. On the liability side, deposits grew by $2.9 billion sequentially to $18.6 billion. Importantly, deposit growth outpaced net loan growth for the fourth consecutive quarter. As a result, we were able to reduce warehouse facilities utilized by over $700 million, resulting in more efficient funding costs as we continue to ramp the portion of loans that are funded by deposits. We exited the quarter with $3.2 billion drawn on our $9 billion of warehouse facilities. We grew tangible book value for the sixth consecutive quarter by a record $204 million to nearly $3.5 billion. In the fourth quarter, we opportunistically executed the buyback of a small portion of our outstanding convertible bonds, which was additive to our GAAP net income by $14.6 million, accretive to GAAP EPS, and additive to our total risk-based capital ratio by more than 30 basis points. Additionally, we entered into a credit default swap arrangement for $2.5 billion of refinanced student loans. These loans were reclassified as held for investment versus held for sale based on the fact that we intend to hold these loans until maturity, given the more attractive returns relative to pricing trends we see in the market today. We do not expect to see that price dynamic changing. The reclassification is consistent with fair value accounting practices and has no overall impact on our revenue and profitability. The credit default swap, however, does improve capital ratios as it significantly lowers the risk weighting for these assets and increased our total risk-based capital ratios by greater than 1% in the quarter. In terms of our regulatory capital ratios, our total capital ratio of 15.3% at year-end improved from 14.5% last quarter and remains comfortably above the regulatory minimum of 10.5%. Let me finish up with our outlook. Before going through specific numbers, I want to review some of the larger macro assumptions that underpin our financial guide. We assume a contraction in GDP in 2024, an increase in unemployment to higher than 5%, and broadly, a continuation of uncertain capital markets activity and continued normalization of consumer credit. From an interest rate perspective, we are assuming 4 rate cuts in response to a contracting economy, higher unemployment, and deterioration and normalization in credit performance, with Fed funds rate reaching approximately 4.5% by Q4 2024. Before I summarize 2024 annual guidance, I want to give some high-level thoughts by segment. 2024 will be a transitional year for SoFi, as the tech platform and financial services segments together will drive our growth and increase from 38% of total adjusted net revenue in 2023 to approximately 50% for all of 2024. Specifically, we expect our tech platform and financial services segments, when taken together, to grow 50% or more, with the financial services segment growing approximately 75% year-over-year and tech platform growing approximately 20% year-over-year. We are taking a conservative and pragmatic approach toward our lending segment revenue, expecting to largely maintain it, given our concerns about the 2024 macro environment as it relates to uncertainty on rates, the economy, and industry liquidity. Therefore, we will manage the lending segment revenue to be 92 to 95% of 2023 lending revenue. This very conservative view of lending reflects our choice to limit lending growth below both the much higher level of demand we have had and expect to continue to see in 2024 and the capacity that we have. Fortunately, for us, the scale and profitability we have achieved in our tech platform and financial services segments allows us to intentionally limit growth of our lending businesses in periods of uncertainty while still maintaining an attractive overall growth rate, significant profit, cash generation, and book value growth. Even with our conservative view of the lending business, we expect 50% growth in revenue of tech platform and financial services combined, and to add at least 2.3 million new members in 2024, which represents 30% growth. Within lending, our personal loan originations could be relatively flat or down versus 2023, while student loan originations could grow just modestly, and home loans growth could be correlated with rate decreases. In terms of capital and liquidity, our total risk-based capital ratio improved to 15.3%, up from 14.5% in Q3, demonstrating our ability to effectively manage our balance sheet and capital ratios through growth in GAAP net income, opportunistic capital efficiency transactions, and loan sales. In terms of our lending capacity, we have the ability to originate $18 to $20 billion in loans in 2024, while keeping capital ratios well north of regulatory minimums, and that's based on growth in tangible book value, amortization of existing loans, and previously announced loan sales. To be specific, we expect to generate $300 to $500 million of tangible book value in 2024, which translates to approximately $2.4 to $4 billion of incremental capacity. Second, loans are amortizing or paying down at an annual rate of $8.4 billion. Third, we have our previously announced $2 billion forward flow agreement, in addition to a number of on-the-run loan sale transactions we expect to execute, similar to the sales achieved in Q4. And lastly, we have headroom in our capital ratio. Having said that, we intend to originate less than the $18 to $20 billion in capacity, and this is based on the factors I outlined previously. With that, let me turn to specific guidance. For 2024, even with our conservative view of the lending business at 92 to 95% of 2023 revenue, we expect 50% growth in revenue of tech platform and financial services combined, and to add at least 2.3 million new members, which represents 30% year-over-year growth. We anticipate adjusted EBITDA margins of approximately 20% in the first quarter, ramping to our long-term target margin of 30% by year-end, which equates to a range for 2024 EBITDA of $580 to $590 million. For the full year 2024, we expect expenses under the EBITDA line to be roughly equivalent in aggregate in dollar terms compared to 2023, excluding the 2023 reported goodwill impairment expense. That equates to full-year GAAP net income in the range of $95 to $105 million and GAAP EPS in the range of 7 to 8 cents. We expect growth in tangible book value of $300 to $500 million for the year, and to end the year with a total capital ratio north of 14%. For Q1 2024, we expect to deliver adjusted net revenue of $550 to $560 million, adjusted EBITDA of $110 to $120 million, and GAAP net income in the range of $10 to $20 million. Now let me turn it back to Anthony for thoughts on our medium-term outlook.
Given the number of milestones we have achieved since we transitioned the strategy of the company when I joined 6 years ago, as well as the fact that 2024 will be a transitional year, we thought it would be helpful to provide a longer-term perspective beyond 2024. For the 2023 through 2026 time period, we see 20 to 25% compound annual revenue growth, assuming no meaningful change in the macro environment and no significant new business launches or acquisitions, such as small medium business checking and savings, or small medium business lending, a broader asset management business, insurance, a broader credit card portfolio, new technology verticals for the technology platform business, or new geographies. The 20 to 25% compound annual revenue growth from 2023 through 2026 assumes a compound annual growth rate of 50% for financial services revenue, mid-20s% for tech platform revenue, and mid-teens for the lending segment revenue. Simply put, this growth only reflects the benefits of the investments we've made in our existing businesses, paired with continuing to build brand awareness, trust, and adoption by new members, and driving cross-buy from existing members. The earnings power associated with this growth is notable and could drive between 55 cents and 80 cents per share in GAAP EPS in 2026. Moreover, we see 20 to 25% EPS growth beyond 2026, reflecting both the continued growth of the core businesses we just described, plus the added benefit from new business lines launched in the 2024 through 2026 time period that begin to scale and impact beyond 2026. Make no mistake, the long-term opportunity for SoFi remains unchanged, and we continue to believe we are just getting started. There are endless opportunities for investment and growth, and we remain focused on the right types of durable growth for the stage of our company and within the environment in which we operate. In summary, we could not be more proud of the results of SoFi in 2023, or even more encouraged by the prospects ahead of us. We have demonstrated the benefit of having a member-centric approach and being a one-stop shop to help our members get their money right, resulting in having a diversified, high-growth set of revenue streams, multiple cost-efficient sources of capital, a keen focus on underwriting high-quality credit, and a high degree of operating leverage as we scale the business to be the winner that takes most in the digital financial services sector. With that, let's begin the Q&A.
Thank you. If you would like to ask a question, please press star followed by 1 on your telephone keypad. If you would like to withdraw your question, please press star followed by 2. When preparing to ask your question, please ensure you are unmuted locally. And please keep in mind we'll only take one question per person at a time. Please rejoin the queue for any additional questions. So as a reminder, that's star 1 on your telephone keypad. Our first question today is from John Hecht from Jefferies. John, please go ahead. Your line is open.
Yeah, good morning, guys. Thanks very much for all the details about the intermediate term goals, and appreciate you taking my question. You guys are taking a fairly conservative look at the economy. I think that's dictating or guiding kind of how you want to balance the growth between the lending segment and the non-lending segments this year. Anthony, I'm just wondering if things kind of pan out a little better than expected, would that change the trajectory? And then how do we think about kind of lending segment versus non-lending segments as we get into next year?
Yeah, I think if the economic backdrop is vastly different, it'll change the trajectory, both up and down. I would think about that both ways. Could be worse, could be better. As I think about the different businesses, some things that could give us tailwind, if we do see rate declines, our home loan business really would benefit from refinancing in the mortgage business and would benefit from greater purchases. Right now, rates are quite high and it stifled the growth in that market, but that would be a benefit. We really love the home loan business for a couple of reasons. Number one, it's probably the largest and most emotional financial decision people make in their lives. And if we're going to be there for a relationship with our members, we have to be there for that decision. It also is one of the most risky. If someone overpays for a house or takes on too much debt in their mortgage, it could eliminate their ability to have discretionary income to invest. And if you do that in your 20s and 30s, it's really hard to catch up later. So it's a really critical product for us delivering on our mission. And it's also a great economic product. We largely do agency mortgages, which means we use our capital just to underwrite it, but then we can sell it to the government agency windows, which benefits the balance sheet quite meaningfully. So that's one business that would be capital light generally. If we do agency mortgages, that would benefit from lower rates. The second business that would benefit from that is as rates come down, you'll see more people looking to get yield in other products like Invest. An offset to rates coming down, some may believe that our SoFi Money product may not grow as fast. What I'd say is from an interest rate standpoint, we are committed to providing a top tier APY in addition to no fees and all the functionality that we provide with 2-day early paycheck and the ability to earn reward points and do person-to-person payments and bill pay and all the other benefits of that product. But because we are an originator and we do generate yield against those deposits, as you know, 6.1% this quarter, we're going to be able to maintain a competitive advantage in what rate we give on SoFi Money. I would say if the rate cuts are in fact 6 times instead of what we're forecasting at 4, I do worry about the economy. I don't see a world in which we have 6 rate cuts and we have a strong economic backdrop. The market quickly switched from in late October, going from higher for longer to 6 rate cuts in a matter of 90 days. That tells you how bifurcated the market is and how concerning things can switch so quickly. So we want to be conservative in our outlook as it relates to risk. We have the benefit of being able to be conservative in our outlook because of what we've done in growing the financial services segment and the technology platform segment. And now that the financial services segment is profitable on a contribution profit basis, we can grow even faster and it doesn't drive our losses up. We're still in significant investment mode there because of the acquisition cost on Invest and on credit card and on SoFi Money. But overall, it's profitable and we can grow it very fast and benefit from that high margin revenue, the margins increasing. And same thing with the tech platform. We invested meaningfully over the last 3 years in the tech platform. We're now in margin expansion mode and revenue acceleration mode. So having all 3 businesses is a direct result of our broad-based strategy of giving consumers what they need to get their money right, but it also results in more durable and diverse revenue streams. In the situation where the economy is weaker than expected, losses will go up. We've seen trends across the industry. The all bank data is very telling in charge-off rates and delinquencies, as well as reserves for losses that indicate that normalization is happening across the spectrum. And we want to be prudent and make sure we factor that into our risk profile. Next question.
Thank you. Our next question today is from Andrew Jeffrey from Truist. Andrew, please go ahead. Your line is open.
Hi, good morning. Appreciate you taking the question. Anthony, I wonder if you could talk a little bit about the company's anticipated balance between growth. I'm thinking specifically in the financial product segment and profitability. You've achieved, at least this quarter, your long-term margin targets, and ostensibly you continue to generate really good LTV to CAC. So are there any factors that limit growth in terms of the financial products segment, or could we actually see that accelerate as the business becomes a little more balanced away from lending?
Thank you for your question. The contribution margin in that business, was break even for the full year and improved meaningfully in the fourth quarter. I would say the major limit on our growth in the financial services segment is how much we want to spend on building awareness and marketing. We have really good customer acquisition cost profiles in the businesses, especially SoFi Money. It's got the best payback period, but we're doing really well in Invest. Investors shouldn't go to sleep on our Invest business. As we mentioned in the call, the AUM increased more than 50%. We launched alternative asset classes today. We continue to give consumers access to products that are typically only available for the wealthy, and we're bringing them to Main Street. We did that with IPOs and now with alternate investments today, which we'll continue to build out also. And in the credit card business, we really hunkered down there and pulled back to make sure we have the credit profile right, our market segmentation right, and most importantly, like we did in money, make sure we have the unit economics right. And I feel like we've made great progress there. So within that segment, it really comes down to how much we want to spend in driving marketing. The products have payback periods anywhere from 12 months to 36 months. So ultimately, we want to manage the overall business to a 30% incremental EBITDA margin. And so we'll invest up to that point. And that's how to think about the limit to growth. But in terms of the opportunity, if we wanted to spend more and not hold ourselves to that balance between growth and a 30% incremental EBITDA margin, we could grow even faster. The market, the product market fit is so great. It's just a question of how much you want to dial it up or down.
Thank you. Our next question is from Reggie Smith from JP Morgan. Please go ahead. Your line is open.
Hey, good morning. Thanks for taking my question. Chris, I think you said that personal loan charge-offs were 4%, I believe, for the full year. I was wondering if you could tell us what that was for the fourth quarter. I guess my math, and it could totally be off. I had you guys at like 3.1 through the first 3 quarters of the year, and that would imply, I think, like a 6% loss rate in the fourth quarter. So I don't know if I'm wrong there. Like any color there would be helpful.
Yeah, no worries. Hey, Reggie. In terms of the fourth quarter, what you heard in my prepared remarks was accurate for the fourth quarter. So our NCO rate for the personal loans business was 4.0%. That was up from 3.44% in Q3 of 2023. As Anthony had alluded to, we do expect a continued normalization towards pre-COVID levels and life of loan losses in the 7 to 8% range.
Next question.
Thank you. Our next question is from Dan Dolev from Mizuho. Dan, please go ahead. Your line is open.
Thank you. Hey, guys. Excellent quarter. Nice work. Anthony, maybe question for you. You provided, nice outlook on profitability into 2026. Can you maybe give us your comfort level on the long-term earnings power of the business? Thank you.
Yeah, I think that there's 2 important indicators for the long-term earnings power of the business, which is what have we done to date, and then what's the sort of incremental way to think about profitability. So 30% EBITDA margin in the fourth quarter is a huge milestone for us. I cannot tell you the number of people that I mentioned our long-term margin at 30% to that were naysayers there. So I'm really proud of the scale that we've achieved at over $2 billion of revenue, but equally proud of what we've done from a profitability standpoint. To have 35% revenue growth, which accelerated with a 30% actual EBITDA margin and GAAP profitability, shows you the earnings potential of this business. The margin could be much higher than 30%, but we're sticking to that as our long-term margin today. As I think about 2026 and that time period, a margin profile in the 30s is what would help us get there and would make it achievable. If you think about our businesses individually and then collectively as a series of unit economic businesses where we're architecting the revenue per account, the variable cost per account to a variable profit margin that obviously exceeds the customer acquisition cost by a meaningful margin and then pays back after 12 to 24 months. As you scale that variable profit per account, you're going into fixed cost base. Once you get that above the fixed cost base, the incremental unit economics just drops to the bottom line. And our unit economics are greater than 30%, which means our long-term margins could be greater than 30%. But we're going to stick with that right now for our long-term margin. It's quite surprising we achieved it so early while we're still growing. So that should be a great indication of what the future could bring. But we're not going to push it higher than that because we want to make sure we hold ourselves accountable to some constraints on what we invest in while balancing growth versus profitability and marching towards higher ROE and greater tangible book value growth. Next question, please.
Thank you. Our next question is from Jeff Adelson from Morgan Stanley. Jeff, please go ahead. Your line is open.
Hey, thanks, guys. I appreciate you taking my questions. I just wanted to follow up on Reggie's question a little bit and dig in on the credit on the personal loan book. I know you did modestly increase the life of loss expectation there to 4.8% this quarter. I guess when we look at some of the ABS data, you know, it does look like the data continues to get worse. And, you know, we have other lenders out there in the consumer world that have flagged that, you know, losses should also get worse this year. So I'm wondering if you could help us frame where you have your expectations for 2024 credit on the loss side going there. Is there a world where you see that overshooting the kind of 4.8% life of loan expectation this year, or do you think that you know, it could kind of hold there? And then as a follow-up, I'm wondering if you could also provide the dollar benefit to NII you got this quarter or revenues this quarter from the new secured financing you announced. Thanks.
Yeah, sure. So on the actual PL losses, I just want to be clear. When I mentioned the 4.0% NCO rate, that was an annual loss rate. Where we expect it to normalize to is 7 to 8% life of loan, which translates closer to a 4.8 to 5-ish% annualized loss rate, which we expect to occur in the first half of 2024. The reason that we get confident that we are going to peak out at those levels is that if you look at our NCOs for Q4 of 2023, about 15% of those net charge-offs are related to credits that we have removed from the system, and that comprises about 3% of the overall UPB on the balance sheet. That's expected to get down to less than 1% by the end of the year. In terms of your second question around the benefit from revenue from secured financing that we announced, we did about $450 million in the quarter, as I alluded to in my prepared remarks. The actual revenue generation associated with that in period was immaterial given time of sales.
And the only other thing I'd add is that our backdrop for credit and credit performance and normalization is tied to our economic outlook. Obviously, in a more challenging economic outlook, those assumptions would likely not hold to be true, and we'd obviously manage the business differently. I would say the one thing that's been true of the last 6 years that I've been here is whatever we thought would happen with the economy isn't actually what's happened with the economy, and we have to be nimble and smart and read all the macroeconomic data points in our own business performances to adjust accordingly. So I don't want anyone to think that the outlook that we have is in all economic backdrops. It's not. It's for the very specific one that we outlined. Next question, please.
Thank you. Our next question is from Michael Ng from Goldman Sachs. Michael, please go ahead.
Hey, good morning. Thank you very much for the question. I appreciate all that revenue guidance by segment for 2024. I was just wondering if you could talk a little bit about the contribution profit outlook, key things to consider for each segment, and any specifics around 2024 by segment would be helpful. Thank you.
Yeah, the way I think about it is the lending business is meaningfully profitable, very high contribution profit margins there. For those who've been following us for a long time, you'll remember the comments that was made about ensuring that our loans have a 40 to 50% variable profit margin per loan, so that those loans will be durable through the cycle, and we remain focused on achieving that. The second thing I'd say is on the technology platform, the margins contracted there quite meaningfully prior to this year as we invested in moving to the cloud from on-prem, and we invested in new architecture and new products and services, and we're now seeing the benefit of those investments coming in higher revenue and more operating leverage, and you saw the nice contribution profit margin expansion there, which you can continue to see with more revenue. It's a business that once you exceed your fixed cost, the incremental profitability is quite meaningful. And in the financial services segment, it's a lot harder to talk homogeneously because there's so many different businesses there. Chris said on the call that we're losing over $100 million a year from a contribution profit standpoint across the different businesses we're investing. Despite the fact that we achieved $25 million in the quarter of contribution profit, we're still losing meaningfully in businesses like credit card and SoFi Invest because of the acquisition costs there, but also because the fixed costs are not covered by the variable profit yet. And so that business has a lot of upside in contribution profit, but you have to think about it by business and where those businesses are in their development cycle. And so Invest and credit card are very early in their investment cycle and therefore losing a lot of money. SoFi Money is now variable profit positive and carrying the weight of the profitability of their overall business. We also have some ancillary businesses in there that are high margin, that are small dollars, that contribute nicely, but they're not the biggest contributor to that area. Next question.
Thank you. Our next question is from Vincent Caintic from Stephens. Vincent, please go ahead. Your line is open.
Hey, good morning. Thank you for taking my questions, and I appreciate all the details. Going back to the rate cut expectations, I wanted to focus on sort of your expectations for how that affects loan sales, and what your pipeline looks like for loan sales. Should we expect a acceleration in loan sales in 2024 if rates continue to go down? And then on the fair value mark, does the current fair value marks actually reflect the 4 rate cuts already, or should we expect that discount rate to decline and therefore increase the fair value mark as time goes on? Thank you.
Yeah, sure. In terms of the overall demand for our loans, the demand remains extremely robust. You saw that we did over $1 billion of sales in Q4, 875 of which came from unsecured personal loan sales, with a $375 million securitization and $500 million of sales in whole loan format. We do expect demand to remain robust. We're seeing that already in Q1. As a reminder, we do have a $2 billion forward flow arrangement in 2024 with a party that has bought loans from us over the course of the last few quarters. That will stay intact throughout the year. And then we do expect robust demand on other on-the-run loan transactions that we've done akin to what we did in Q4. So overall, really good demand at strong execution levels, as demonstrated in my prepared remarks. In terms of the fair market value marks, do these include the 4 rate cuts already? Our marks are reflective of a point in time. So as of the end of Q4, the marks reflect what the underlying benchmark rate as of December 31st.
So they don't reflect the 4 rate cuts going forward. The other thing I'd say is, as we think about our durability of our loans, we have continued to reduce our credit box. In this late December, we reduced underwriting by eliminating what we call tier 6 and 7, which is the higher end of our FICO band. As those that know the company, we underwrite 680 FICO and higher, and our average is much higher than 680 in the mid 7s, as we talked about earlier. But as we progress through the year, we have reduced our credit box, and we continue to do so. And in December, making a relatively big change on 6 and 7, so that our loans are durable through the cycle, whether we hold them on balance sheet or we sell them.
And then the only other thing I would add, just to follow on to my point around do the marks include the 4 rate cuts? As you all know, we hedge interest rate exposure on our loans. So when interest rate drops, the value of the loan increases, but that's offset by hedge losses. Similar to what happened in Q4, we saw meaningful interest rate reductions, but we also had meaningful hedge losses that offset that.
Thank you.
Next question, please.
Our last question we have time for today is from Dominic Gabriele from Oppenheimer. Dominic, please go ahead. Your line is open.
Hey, guys. Thanks so much for the question and the color across the call. So maybe, Anthony, you can talk to us, or Chris, through the assumptions that lead to your mid 20% revenue growth within the tech platform. That'd be really helpful. Maybe including, if possible, breaking it down by the new client wins, pipeline for deals, customer adds, anything you can provide. I feel like this target's likely going to be of significant importance moving forward. Thanks so much.
Yeah, we're not going to get into that level of detail. We're in market in conversations with dozens of potential partners across the spectrum of the diversified customer base we have. We have ongoing dialogue with everything from government-related deals for child support and benefits from the federal government, all the way to new consumer financial services offerings from large established non-financial services brands,
all the way to big, large traditional banks in our country. The drivers of the business are quite simple. We have an underlying payment processing platform that you should think about generating revenue based on two factors. One, getting paid based on the transactions that occur in that platform, the volume of those transactions, and the price for those transactions, in addition to the APIs that we provide. Within the technology processing platform, we provide APIs for account opening, for bill pay, for two-day early paycheck, for person-to-person payments, for payment risk platform fraud capabilities. And so different partners use different APIs, and the more they use, the more we get paid. But it also drives the more transactions. In addition to that, we have other products like Connecta, which is a natural language chatbot that uses machine learning. We also have a product called Payment Risk Platform, where we're helping people decide instantaneously on the risk of a transaction and whether or not it should be authorized or not. And we get paid for each one of those authorizations. In addition to that, we have Technisys' Banking Core, which is a much larger decision for any institution to use, but think of a core as an operating system. Our Technisys capability we bought for one big reason. We have a lot of products at SoFi. Those products all have different operating systems. We want them to run on one platform, one operating system, and we want that system to be extensible into new products that don't even exist today. In the financial services industry, many banks, many financial companies have many cores. In fact, they probably have more cores than products because many of them were aggregated roll-ups of other banks that had different cores for checking and savings, not to mention they had different cores for products like credit card versus checking and savings, or even for loans. And so Technisys enables a company to have one platform running different cores for different products, and it's extensible into different areas. One example of that is SoFi's Buy Now, Pay Later. We launched Buy Now, Pay Later with Galileo and Technisys and SoFi. It was the first product on all three technologies, and we did it in a very short period of time, and it's a great product that is easy for the consumer to use and can be authorized right in the application itself. And so that is another driver of the overall revenue streams. We also do services for digital solutions. We do build front ends for apps in addition to other types of digital services as it relates to the app and product development. So there's no one answer to your question other than more partners, more accounts, and more products per account, which drives the revenue from those factors that I just laid out. That ends our prepared remarks and questions. I wanted to finalize our comments today by just sharing with you some final thoughts. I'll finish here by saying how proud I am of our team's relentless ability to not just persevere through the disruption and volatility of the industry throughout the year, but to deliver record results. I couldn't feel more blessed by our more than 7.5 million members that have been so critical in making our vision of being a one-stop shop for all your financial needs become such an amazing reality. The benefits of our strategy resulting in a uniquely diversified business that is unmatched by any digital-only provider in our scale, capability, and competitive advantages not only position SoFi to be the winner that takes most in the sector transition of financial services to digital, but also provide greater durability through a market cycle. I'm excited about where we are today and even more excited about where we can go from here. Thank you for dialing into our call, and we look forward to talking to you next quarter.
Goodbye.
All right. That
Thank you, everyone,
is
for joining today's call. You may now disconnect your lines and have a lovely day.
the end. Yeah, that's it. SoFi ends the call. The stock is currently at above 17%, 16.5%. Definitely not a horrible earnings for SoFi. And if you are betting on the stock, definitely not bad as well. 15.5% right now in the pre-markets. We got about 30 minutes until the market opens. $8.82 right now on SoFi. And obviously, we're seeing some upside momentum here on the stock. Here's what my plan is with my SoFi position. Okay, this is my exit plan today. And this is what I want to do. Don't know if it's going to happen, but let me just show you guys what I'm looking at right here. So this is where I put in a limit order. We'll see if it fills in the morning. I'm not sure exactly if it's going to fill, but we'll see what it looks like. So these are the calls that I have. $12, $17 calls. It's a spread between 12 and 17. for SoFi. Basically betting that SoFi can be at least $12 by 2026. These spreads I bought at an average price of 70 cents. It's at 58 cents right now. That was kind of like on Friday. It just randomly tanked 12 cents. It's supposed to be closer to like 69 cents. It's not really supposed to be at 58 cents, but like randomly stuff happens with options. So I put in a limit order. I bought these at 70 cents to sell them all at $1.40. Okay. So that would be $140 a contract. I bought them for $70 each. That would mean the 4,200 I put into this basically turns into about 8,500. So I would double, and it would make about $4,000. Now, do I think a 16% move in the stock will be a 100% move in these options? I don't think so. So I'm being a bit optimistic with my limit order on these bad boys because I don't actually think it's going to get there. I think more likely than not, it's going to get maybe up 50 to 60% if I'm doing it right, maybe up 30 to 40%, and we'll see where it goes from there. Now, if SoFi obviously goes up to that $9, $9.40 range, I think 100% move in the options is very possible, given that would be like a 30, 40% move in the stock. 17% moves in stock in the context of options usually have a decent, either 2-to-1 kind of ratio in terms of how they move, which means this would be up almost 34 to 40%, or maybe even 3-to-1 sometimes based on how volatile it can be. So it really depends on the liquidity, depends on how the options market is trading. But that is my exit. As soon as the market opens, I'll show you guys if they close or not. And if they don't, we'll lower the exit price. I do want to get out of them today. I don't want to be holding this for a long time. These are options, and I'd rather get out of them than hold them. But let's see. Let's see how the market interprets it. And maybe it goes from there. Cool Comic Guy says maybe it'll be $12 by February 26th. See, the one thing I don't like about SoFi, even though this earnings smashed, and we'll review a little bit of it and why I think they shouldn't sell off, is that they tend to sell off. That's the problem. It tends to sell off even when it does that good. Now, look, it's up 16% right now, which is amazing. And usually in the pre-market, if something's up 16%, you don't imagine it tanking as soon as it opens. Last quarter, we had a triple beat, but we were barely up in the pre-market. And then during the market open, we tanked. I think SoFi went from 740 to like 680 or something. And it sucked, right? Was not good. This time, things have changed. SoFi is gap profitable. SoFi is guiding for 50% revenue growth from the tech business and the financial services business put together. 545,000 members, actual EBITDA margin of 30%, 181 million. They basically doubled their EBITDA quarter over quarter, 98 million last quarter, 181 million this quarter. And the margin is the highest it's been in 6 quarters at 30%. The past 5-6 quarters has been 11 to 18%. So I think Noto at the end of the call was basically saying, look, we think we're going to continue to remain profitable, about $100 million of profit this year. We are decreasing the amount of risk exposure we have to loans. So the reason the financial business and the tech service business needed to grow at 50% year over year, especially in 2024, is because the macroeconomic environment, SoFi is saying, hey, we're not sure it's the best right now. And as a result of it not being the best, we are decreasing our exposure to loans in terms of how many loans we're going to be issuing. We're not going to sell as many loans. That's the nature of that. That's what they said in their guidance. Because they're afraid that people won't be able to pay back those loans, right? There's going to be more delinquencies. So the market, I think, is very excited. And that's why we're seeing this nice gain in the stock, because if they're not going to be giving out that many loans, or at least as much as they said they did last year, and they're going to have a lot of risk mitigation in terms of how much they're issuing those loans, then some other part of the business has to grow outside of the lending business. That's where tech and financial services comes in. And if that can grow, which it was at 38% last year, at 50% this year, which is what they're guiding for, that offsets the lack of growth in some of the other areas. And it's a less risky type of growth. It's more of a SaaS multiple type of growth, which gets the market very, very excited at the end of the day. Sachin says they not only 2x their EBITDA, but they're lowering the risk also as they hedge their student loans with credit swaps. Yes. And this is something the Crystal Point, the CFO, talks about at the end of the call, saying that, look, when interest rates tend to go down, the value of your loans tend to go up. However, they're hedging those bets with credit swaps just to make sure that if interest rates don't go down, or they don't go down as much as they think they're going to go down, that they are protected from that perspective as well. Their guidance is in pricing in 4 rate cuts this year. That is correct. So one interesting thing by Noto at the end of the call is he said, look, we don't think there's going to be 6 cuts, because 6 cuts means that the economy is in a tough situation. And we actually think there would be some worry if the Fed has to cut 6 times, because that would be a little tough. However, we do think it can happen 7 times. or sorry, not 7 times. We think it can happen. That would be bad. We think it can happen at least 4 times, which would be 1%, right? So we would go from 5.5 to 4.5. And we're preparing for 5% unemployment. So you've got GAAP profitability, 2x the EBITDA, 30% EBITDA margins, increasing growth by 40% year over year, all with the assumptions that there's going to be 4 rate cuts, probably in the back half of the year starting in May, and 5% unemployment. If we don't get those numbers and SoFi is still able to grow at these levels, if not more, then you're just looking, at a business that's at a better position, even if the assumptions don't take into account, don't end up being as bad as they thought they would be, which is good, which is not that bad at all. Sachin says we may not have 6 cuts, but cuts can be 50 basis points and 75 basis points after the first tranche of 25 basis points. That's correct. So, so they assume that we're going to be at a Fed's fund rate of 4.5%. So even if we have 4 cuts, if some of those cuts are more aggressive than other cuts, if we start with 25 and then go to 75 and then 50, then you would see a full 1.5% of a decrease versus just 1% of a decrease in the Fed fund rate. So overall, very good call by SoFi, man. I mean, there's nothing you can complain over. And this is the thing that I'm the most excited for when this market opens. It's up 15% right now. Is the street going to still be annoyed at this? JP Morgan put out a hit piece last night saying that SoFi is going to miss on their EBITDA. They said SoFi would do 516. SoFi came out swinging out the gates this morning. They said, no, we did 580 million. And the JP Morgan thing was so weird. It came out at 11 p.m. last night. It's like, all right, so I guess these guys are really trying to make sure they get a juicier price tomorrow, or they're trying to do something. But SoFi beat on the numbers they needed to beat. There is no number I can look to that's necessarily problematic, bad, or assumes a particular assumption that could lead you to feel that it won't be met, or it could be met with some volatility. At the end of the call, when they asked about specific numbers around the financial services business, or sorry, the tech business, Noto didn't exactly explain what customers they're working with or the assumptions they used to get to those levels of growth. At 20% year-over-year growth, they're assuming for the tech sector, 75% financial. So if you average it out, it's about 50% tech and financial services. But he did talk about a variety of different products, stuff that I didn't even know that SoFi had. All these different sort of software solutions SoFi offers to different big businesses. Obviously, Technesis is a larger offering they would use for a client. But even something like a chatbot, I feel like I've heard about this a while ago, but I haven't thought about it. That apparently SoFi has a chatbot that they can sell to a variety of different institutions that helps you, using machine learning, be able to interact with customers in a more significant way, especially given all the products that SoFi has. So there is a variety of things on the tech side of the business that can grow. And if it grows the way it needs to grow, I'm not saying SoFi is going to get a SaaS multiple, but they're definitely going to be hedged against only getting a multiple that applies to banks. It's not going to be, in the infamous words I said many months ago, just a bank. It's going to be a little bit more than a bank. And I think the market right now is seeing that, hey, if SoFi is a little bit more than a bank, maybe we should be giving it a little bit better of a premium as well. So we're going to see what happens with SoFi, but put in the chat if you own SoFi. Put in the chat if you want to put how many shares you own of SoFi. I think a majority of people here own it, and it's a great quarter. Noto killed the call, answered all the questions really well. No major issues I'm seeing from the call. And I think as long as the market is able to maintain some of the gains, because that's the toughest part with SoFi, there should be some momentum. If you are short SoFi, which is there's a 13% float, 13.6%, I don't know if you necessarily cover, because the earnings call on paper, if I read it, I would cover, because this is a stock that can double, in my opinion. I mean, this is a stock that is absolutely undervalued in comparison for the growth and the multiple that the market's giving it. But the problem is, if you think the big banks don't like SoFi, the Goldman Sachs, the JP Morgans of the world, and they don't really want the stock to go up, and at the end of the day, they have to buy the stock in order for it to go up, you might not be in the worst position if you keep your short. And given general macroeconomic issues, February sucks for tech stocks. I don't know if the incentive structure is there for the shorts to cover today. I really don't. And if it, I think honestly, SoFi would be a lot higher right now if we saw a massive squeeze, but we'll see when the market opens, up 14%. We'll see if they can get to that up 20, 25%. And then I would imagine there's a squeeze. But so far, I don't know if the shorts are super incentivized to give a squeeze right now. We got 200 shares, 350 shares, 840 shares, 300 shares, 2,000 shares, 2,500, 1,000, 2,600 by Michael Wilder, 20% of the portfolio. Joseph Viegas in shares, 824, 60 contracts. Not bad at all. 5,000 shares. All right. So we all own some SoFi here and want to see how SoFi does. Real Baby Pluto says, are you going to say gap profitability or not, bro? That's why I'm here. Yes, SoFi got to gap profitability. All right, there you go. SoFi got it. So that's what I did for Palantir. I had to get a little Michael Jackson in there. We got profitable. Which begs the question, how's Palantir going to do? We have 6 days, ladies and gentlemen, till Palantir earnings. So maybe we transition to them and we keep talking from there. So that was SoFi. If I have chapters in the earnings call, if anyone wants to watch a little bit more about what I said in the beginning. So we talked about it for 30 minutes and then we had the call. So you can look at my initial reaction there if you want to go back. But we'll transition a little bit more to the macro and Palantir and a variety of other stuff that's going on. We've got to talk about China. China has some issues. And then we got the market open in 15 minutes. And we'll see if the SoFi calls can print some money today and go from there. Macro Jackson. Dude, that should be the name of my new channel, Macro Jackson. Oh, by the way, let me share this to you guys. So I posted the second part of the Meet Kevin interview. Let me just put it in the chat for anyone who wants to check it out. It's basically asking him about his life and, how he became who he is. So I'll put that in the chat. If you guys want to check it out, can subscribe there. I'm going to be doing daily videos now on Macro Darts, which is my new YouTube channel that talks about all stuff outside of Palantir and more macro. Like if I want to do a Robinhood video or PayPal video or a SoFi video, that's going to be on this channel. So if you guys want to check it out, this channel is going to be the channel where you can get all of that coverage. Do you have a stop for those options? No, I just have a limit order to sell. I don't have a stop. The thing is on the options, I got them really cheap. So I would be very perplexed if they come in below where I bought them at, especially given the 15% run up today. I'm definitely selling them today. Like today's going to be a sell. Either I get to sell them for a huge gain or a small gain, but I'm not keeping them for a while. I just don't trust this stock in this environment to stay pumped at these levels. And if I'm wrong, I'm wrong. I don't really care. But I got to get rid of them today because I personally, just from a risk mitigation perspective, I don't trust SoFi, the stock, to maintain its gains. And I don't know what the market needs for it to maintain its gains. Maybe a quarter like this is enough. But I think there's a pop today. If you want to sell a little today on whether calls or shares, I think it's worth it because I just don't know if they maintain. I really don't. These are not in my IRAs. What are you going to do with those gains? Well, if I actually bet 4,200. If we make 2,000, I'm maxing out my Roth IRA because I have like 2,000 left to max out the Roth IRA for the year. So I'm maxing out the Roth IRA and I'm putting all that into Robinhood options. That's what we're actually doing if we get the 2,000 in gains. But we'll see. I'll show you guys as soon as it opens. The rest I have to. Honestly, I got to pay a couple little bills here and there. So I'll take that $4,000 out and I'll just get rid of some bills. So nothing crazy. If we double the options, it'd be amazing. We'd make $4,000. If not, hopefully we can at least make 1,000 today. That'd be awesome. If, we make that off of the $4,000. Okay. China. Let's talk about China. We got a lot to discuss in the world of China. We talked about China a while ago in terms of their issues over the past couple of weeks. And obviously they pumped a crap ton of money into their economy and they tried to, rescue the stock market. Alibaba's up right now just a little bit. NIO is down a little bit. So the Chinese stock's not too affected by the news that happened, but the news was that Evergrande, one of China's largest property developers, has been ordered to liquidate from a Hong Kong court. Evergrande's liquidation is likely to send another shockwave through the Chinese real estate industry that has already seen dozens of developers collapse over the past 2 years as banks pulled back funding and property values underwent a sharp correction. The Chinese real estate market is not doing very well. The company was once China's biggest property developer by sales, but saddled with some $300 billion in liabilities. Evergrande stopped paying its debt over 2 years ago and has been negotiating a restructuring with its creditors ever since. So this is something that did happen about in 2021. I mean, this news story kind of broke and it was like a big story, but obviously with China and everything that's going on, it was kind of swept under the rug and just things kept progressing forward and you thought China could resolve this thing. But they haven't been paying their debts in over 2 years. And the reason they haven't been able to pay their debts is because they just didn't have the money or the ability to pay off the interest on those debts to continue to exist as a business. The court order from Hong Kong will give creditors control over Evergrande's parent company, allow them to liquidate all of its businesses, which basically means that they're finally going to be able to make some money off of this, even though the asset has been massively depressed. The court will now appoint a liquidator for Evergrande's parent company. The liquidator will be empowered to take over all of Evergrande's subsidiaries around the world, including in China, and sell the company assets to repay its debt. Much of Evergrande's assets have already been sold, seized by creditors, or frozen by Chinese courts. The developers' dollar bonds were bid below 2 cents on the dollar on Friday. That's incredible. That is absolutely incredible how bad this Chinese, this Evergrande situation has been. Now, this hasn't like obviously been the one thing that has ruined some of the Chinese infrastructure. Evergrande is a one part of a larger story around what's going on in China in regards to youth unemployment, in regards to the real estate crisis, and in regards to the general kind of hesitancy that investors have to actually invest into the Chinese economy. Obviously, we saw what they did with Tencent a couple of weeks ago, and what they've been doing with Alibaba over the past couple of years. But this definitely isn't good news for China. Now, one of the ways that it could be good news is that it's a way China can finally move past this, issue in regards to Evergrande being one of those things that's just been kind of left and inside of the economy that hasn't been resolved, and that's why other investors have been afraid to invest into the economy. However, it's one of those things that's going to create a liquidity event for the parent company of Evergrande, and the question becomes: is that liquidity going to give the creditors that now have access to those goods the ability to invest that money in different areas? And is that going to at least increase the capacity for more real estate projects to start in China? The biggest problem right now is that the Chinese government hasn't been able to save Evergrande, right? They haven't been able to bail them out. They offered a $278 billion package for the stock market, and they didn't print money. They sold off some assets and some offshore accounts, and last week they pumped that into the stock market. That's why you saw Alibaba, that was up 8%. NEO was up about 10%. But in the context of real estate, it's a much more corrosive problem, and I think the Chinese government probably could have bailed them out at the tune of $300-500 billion, but it wouldn't be enough to solve the issue. And this is what I talked about last week on the market open, which is that the opening of the credit, the reserve requirement ratios for banks at the tune of $139 billion, about 1.3 trillion yuan, the 278 billion pumping into the stock market. None of it, in my opinion, was enough to long-term make the Chinese economy stable. But in the short term, it pumped some of the equity prices. So we'll see where it goes over the next couple of months. But it definitely, isn't the thing that I think investors are looking for in regards to being super excited to go back into China. And so we'll keep an eye on what's going on with China, but that is some of the issues currently in the pre-markets. This news broke on Saturday, or sorry, I think it broke last night at like 5 p.m. in terms of how China is dealing with their cascading real estate issues. Let's take a look at some of the charts we have right now for these watch lists that we made on Friday. Crypto is all green in the pre-markets. You got CleanSpark up about 2.5%, Coinbase is up 1%, Robinhood up about 1%, Bitfarms up 2%, MicroStrategy up 1.3%, Riot up 1.4%. All the Bitcoin miners are up, and they were up on Friday, which is really nice. MicroStrategy at $500 right now. So nice gain in Bitcoin at about 3%, which is why we're seeing some momentum there. The semis are green as well in the pre-market, but not as green as they were over the past week. Now, the semis, in my opinion, they've ran up dramatically, right? NVIDIA at 614, SMCI at 474, even ARM doing well at 71, ASML at 867. So I wouldn't be surprised to see a little bit of a pullback in the semis, just because, I mean, it's up almost 25% across the board, 10% on the SMH ETF over the past month. So I don't know. We'll see what happens in February, but I don't know if we're going to expect the same types of gains. AMD, we're getting earnings on Tuesday. That's going to be very exciting to see how they report their numbers, but I think the market has definitely front run a lot of their growth, getting it from, it was at 114 a month ago. Now it's at 170. So you would imagine the market's pretty excited for some of the growth they can show. SoFi right now, 15.35%, 879 in the pre-markets. And let's see where it can keep going from there. Where's Verizon in the pre-markets? Where do we have Verizon? Verizon is down a little bit, 42.35, down about 0.12%. Mag 7 is up right now in the pre-markets. Microsoft is up. The only one that's down is Apple. Even Tesla is up about 1% in the pre-markets. NVIDIA is up. Amazon's up. Oh, by the way, Amazon's deal with Roomba officially has been canceled. So Amazon has canceled their Roomba deal. This was the deal they had to buy not Roomba. Why am I saying Roomba? iRobot. Why did I say Roomba? Is it? Oh no, because iRobot makes the Roomba. That's why I said Roomba. So their $1.4 billion deal, they have terminated today. The European courts, I believe, blocked it a while ago, and like 2 weeks ago, by the European Union. And today they announced that the iRobot deal has no path to regulatory approval. iRobot is also announcing that's laying off 350 employees, around 31% of its workforce, as a part of a restructuring. This kind of sucks, dude. I don't know why the European Union did not let Amazon buy the freaking Roomba. Like, Like, was it that big of a deal? What was the Roomba that complicated for Amazon to, like, was it that monopolistic for Amazon to just buy a robot that vacuums your house? Like, I don't know. It's like, when I think of anti-competition, I think Microsoft and Activision Blizzard that somehow got approved is a bit more in the anti-competitive lens. When I think of everything that Apple's doing with their App Store, on Friday, if you guys were in the market, closed, Daniel Ek, CEO of Spotify, wrote a pretty passionate letter detailing how corrupt Apple is acting in regards to their ways to skirt around the DMA Act that Europe passed. And basically, if you're a developer and you do 10 million in sales on an app in Europe, after taxes and after Apple's fees, you're getting maybe $2 million back in gross profits. I mean, it is ridiculous that they're charging 50 cents per download at this point. They're charging 17% of revenues. And I mean, Apple is what the European Union should be going after, not Amazon buying a vacuum. Like, it's a bit ridiculous. It's kind of crazy. You can't let Amazon sweep the competition. Maybe. I appreciate the dad joke, but you can't let them sweep the competition. I mean, it's just kind of ridiculous. It's kind of ridiculous. Got to protect that automated vacuum robot market. Yeah, we have to protect the intellectual property of iRobot. It's so dumb, dude. It's so dumb. They suck anyway. I have pets, need to really clean the floors in my house. Yeah, that's the other thing. I don't even use a Roomba. Who uses a Roomba? I use a regular, I don't know what it's called, but you guys, it's one that's become very popular. I don't know the name of it, but I use it every day because I vacuum basically the whole house every day downstairs. That's just what I do. I like vacuuming. I like making sure that things are nice. And then I mop as well. I'm just like, I clean the house. I'm good at cleaning. But like I don't even use a Roomba, dude. I wouldn't trust a Roomba to actually clean my house. Like, I feel like you're not going to clean up any of the mess if you use a Roomba. So it's hilarious that, Amazon, that the European Union is doing this, but it is what it is. Oh, the Dyson. Yes, the Dyson vacuum. Dude, that Dyson is phenomenal. That Dyson is great. Even though I have to buy like 3 of them because this shit but I got a warranty on this last one. The Dyson is great. So yeah, the Dyson is what I use, and that's what we have to use. We got FTC chair Lina Khan. Let's see what she has to say. She's suing Amazon. Speaking of Amazon, let's see her speak for a couple minutes, and then we'll move on from there.
Commission looking into recent deals made between big tech giants Microsoft, Alphabet, Amazon with artificial intelligence companies like OpenAI and Anthropic. The agency is saying it's going to scrutinize, quote, partnerships and investments to better understand their impact on the competitive landscape. Joining us right now in an exclusive interview is FTC Chair Lina Khan, and we're thrilled to have you at the table this morning. Nice to see you.
Good to see you. Thanks for having me.
So help us understand how you're looking at this. These deals, if you will, are not classic mergers, if you will. These are effectively investments, but maybe they look a little bit like mergers to you.
So we are looking closely at the strategic investments and partnerships between Microsoft and OpenAI, Alphabet, Amazon, and Anthropic. And the goal here is really to look under the hood and understand precisely what is the nature of the relationship here. What are the deal terms? Is there exclusivity that's expected or required? Is there going to be privileged access? Are there rights to board seats or other mechanisms to be exerting control or influence over the business strategy? And just to step back, I want to explain why we're doing this. Right at this moment, AI is a nascent technology that could catalyze enormous growth and innovation. There is enormous opportunity here for a vibrant market, but we also see risk. We see risk of consolidation. We see risk of monopolization. We're already hearing some of the classic national champion arguments, the idea that it's in somehow America's national interest to be protecting monopolies. And unfortunately, we've been down that road before. We see very clearly now with Boeing some of the dangers of that strategy, where you had United CEO Scott Kirby draw a straight line between the 1997 merger between Boeing and McDonnell Douglas and some of the problems we're seeing now with planes falling apart in the sky. So we need to be careful.
Part of the advance, and frankly, the advance that the U.S. companies, OpenAI, Anthropic, and the likes have had, is the scale of capital that they've been able to access. So one of the things that AI requires more than anything else is literally just server farms. And it is super expensive, billions and billions of dollars. And effectively, as you know, OpenAI was not for profit. It effectively needed the money ostensibly from Microsoft, but the question is, are there private markets or other money that you think that these companies could have accessed rather than doing it with the traditional folks that are probably most incentivized to provide those funds?
Look, I think you're absolutely right that these markets and some of these layers require enormous scale, be it at the compute level, be it at the data level. I think we just need to be very wary when you have some of the existing incumbents that are threatened by this moment of technological disruption, that they could be using this moment to try to protect their moats and protect their monopolies rather than allow the opportunity that this technology presents to fully flourish.
Look, the weekend that Sam Altman left OpenAI and then came back in, and everything we heard from that, I mean, it did seem like a possibility that Microsoft was going to get basically a stealth takeover of Sam, his team, all of that information. That did make me look at it a little differently. Have you figured out what happened? Is that what kind of set things off for you?
So we've been watching this space quite closely. As a general matter, we launch an inquiry into cloud computing. That's another layer where you see significant amount of.
All right, so we got the market open in about a minute. In the context of what Lina Khan said, I kind of agree with some of the stuff she's saying around just making sure we're more protective of some of the big tech companies not becoming monopolies, because that is something that could happen. The problem is the things they try to go after are a little weird. SoFi right now, 882. We'll see what happens in about 30 seconds. There is an argument that we can't let AI become monopolized. And, obviously Microsoft wants a ton of regulation because they are already in the front seat of it. But some of the stuff Lina Khan has done in the past in terms of trying to go after these companies, it's just not been the most effective in my opinion. So especially the stuff they're doing with Amazon. So we'll see what happens from there. But right now, I think the big tech companies are big tech, and it's going to be very hard to, dethrone them. All right, all eyes on SoFi. We got 10 seconds, folks. Let's see what happens. Up 15.75%. I have an active position. As soon as this market opens, we'll see what happens there. And let's get into it. Ladies and gentlemen, the stock market is now open. Wake your ass up. SoFi opens up 13.35% on the day. Oh, wow. All right. So here are these options. They have ballooned to be pretty high today. So the options are up. Let's see how much they sustain themselves. So this is what I'm looking at right here. Let me show you guys what I'm looking at right here. What I'm looking at right here are call options that are at now $1.07. They're up 2,100. They're up 50%. They're up 50%. Okay, so I put in a limit order on these bad boys for 140. I am fine with 50%, so I'm going to change that right now, and we're gonna redo this. We're going to redo this. Let's see if they fill. That's the big thing. Let's see if they can actually fill. So we're going to change it right now. I have them at 140 limit. I'm going to replace the order right now. We got to do this live. And where are they trading at? They're trading at $1.09. Damn, they're up 87%. All right, here's what I'm looking at. Here's what I'm looking at. I have 60 of these. I told you guys in the pre-market this is what I was going to do. I think we sell them. I think we sell them at $1. Let's see where they fill. Would they fill? I don't think they're even going to fill at $1.09 though. All right, we're going to do 105. Let's see. Let's see if they fill. Let's see. All right, we submitted it. Let's see if they actually fill. Let's see if they fill. I'm not hopeful they're going to fill because I don't know how the market's going to think of it, but let's put it up there. All right, let's go through the rest of this. Keep going. Wow, SoFi's up 17%. Look at that. Trying to hit $9. Trying to hit $9 right now. That is not bad at all in the context of SoFi. Look at that. Look at that. They're up 17%. Holy macaroni. They are up 17% right now. Well, SoFi. Oh, there you go. Broke through 9. Broke through 9, folks. Breaks through 9. $9.08. 19% on SoFi. Wow. Wow, wow, wow. There's your buy side pressure. There's your buy side pressure. It is here. It is here. It's up 20% in a day. The stock is up 20% in a day. Crushed through $9. Absolutely crushed through $9. Options are now down to 96 cents. So that's what I'm saying on the options. I don't know how volatile they're going to be. They did not fill yet. Yeah, I felt. Look, I was a little bit too. Now they're at 88 cents. I tried to get them up at $1.06. They're at 88 cents. So they're definitely not filling yet. But there you go, folks. SoFi $9.10, up 19% of the day. That's not bad at all. That's not bad. We'll get back to SoFi in a second, but they're up 18% right now. Alibaba 74, Google 153, Meta 394, Apple 192, Microsoft 404, S&P 487. S&P again continuing to open and just do well. The S&P continues to be green. February is going to be very interesting month for the S&P 500. Palantir is 1620 or 1660. Palantir is up 1.5% of the day. Robinhood is flat on the day, 1079. Uber 65. Bitcoin 41,925. Lululemon 478. Datadog 124. SoFi again up 20% on the day on SoFi. Told you at 9:20 at market open. Give it one more minute. So let's see. Let's see now. It's a big day opening up 18%. There you go, right under $9. Let's see where it did hit 9:20 though. It definitely did hit 9:20, which was the exciting part. It did indeed hit 9:20. I don't know. Let's see. Let's see. Okay, so I'm getting a fill at 90 cents. They're filling at 90 cents if I want to take it at 90 cents. Do I want to take it at 90 cents though? Do I want to take it at 90 cents? They're actually filling at 90. I don't know. I feel like that's too little for 90 cents to let them fill. We're going to put it in order at just $1 and see if they fill there. We'll put them at $1. I feel like 90 cents is a little bit too low. 0.98. I'll put it at $1. Oh, they're actually going to fill at $1. Are they? Are these actually going to fill at $1? Oh no, because that was on open, not close. 60. All right, let's put it up there. Let's see if it goes. But there you go. SoFi above 9. SoFi above 9. That's exciting. The growth justified them being up at 9. The growth justified them being up at 9. We looked at what they had. Robinhood at 1080, Palantir 1659. They definitely deserve this boost today. The question is how long it's actually going to be able to last. SAS is up right now. We made a bunch of playlists over the weekend. And if we look at SAS, if you look at the right-hand side of my screen, that's green. So SAS is absolutely green, which is not bad at all. What else do we have? Healthcare is a little red, nothing too crazy there. Defense stocks are green, except Raytheon. Palantir is one of the big ones there. And then banks. How are banks doing? Banks are red. Wow. SoFi is the only one that's up. JP Morgan's up a little bit. PNC is up a little bit. XLF, KRE are up, but rest of the banks are down for today. SoFi is the one bank that's up at 17% right now on the day. All right, so these guys are not going to close at $1. So we've got to redo this. Let's see where they would close. Would they close at 0.9? Do we just take the 0.9? I think we just take the 0.9. We do it there. Let's see. Will they close at 0.9? No, they don't. They're not even closing at 0.9, dude. Where are they closing? 0.85? Damn, they don't even close there. All right, I'm going to put 0.9 and just see what happens. This is the problem with some of these options, dude. It's like it's hard for them to find their fill, even if the stock is doing very well. Over 55 million in volume. Wow. 55 million in volume. Goodness gracious on SoFi. June says, I feel like I'm watching you in Vegas gambling. That's basically what it is, right? The good thing is these expire in 2026, so it's not the biggest deal in the world, right? That's why I'm having a hard time selling them. It's because someone has to buy them for 2026, and we got to find some exit liquidity here. Oh, they failed. I think they failed. They failed. We got him, folks. Wait. Yep, they failed. We just made some money. They failed. Did they fail? They failed. I think that, yep, they failed. We made some money. So how much did we make? We made, let me just get the exact number. Wait, why am I doing this wrong? 60 times, hold on, 6. So we made $1,200 today. $1,200. We made $1,200, folks. We made $1,200. There we go. We made $1,200. And we got in at a good price, dude, because right now the options are down. So this is what happened. So we got them. We got 60 of them sold at 90 cents, $90 a contract. So that's 5,400. You see that right there? And I bought them for 70 cents each. So I bought them for 4,200. I sold at 5,400. We have made $1,200, ladies and gentlemen, and we made it in about 2 weeks. Not bad. How much of a gain is that? So that's not that crazy. 90 this by this. We made a 20% gain, I think. 28%, 28.5, so 29. We made 30%. We made 30% of our money. We made 30%. Not bad. I'm surprised they fill, dude. I didn't expect them to fill because these options are very volatile, right? So I got them at 90 cents. You know how right now it says 92 cents? It's a question of, if they're going to actually fill above that 90-cent range. So 90 was the golden range. Right now it's at 97. It says 97, but it's hard for them to fill at those levels. So if I got it at 90 cents, that means someone was willing to pay at least 90 cents for them. The question now is just, is someone going to be able to pay a lot more than that? But $1,200 is not too bad. It's moments like these that remind me. So we made like $750. No, we made $1,200. So I bought them for $4,200, sold for $54. So we made $1,200. We made $1,200. It's moments like these that remind me how cool it is to invest in the market, because it's like I took $4,200 of my dollars, I put it into an asset. I had a calculated bet on how that asset would move, how that asset would then move. And then the asset performed the way I wanted it to perform based on their earnings. And then as a result of that, someone was willing to pay more for that asset than I paid for it. 30% more in a matter of, I think it's been 2 weeks. Yeah, 2 weeks is when I did this. And then boom, we make some money. Not bad. Not bad at all. Short-term capital gains says, yeah, we got to pay Uncle Sam on this. But that's the cool part about the markets, dude. That's the cool part about the markets, is that you could actually, make some real money here. Someone's saying, why'd you sell if they're 2026? For me, this was a more of a short-term bet. It's not that I'm not bullish for SoFi for the long term. It's just I am very skeptical on the stock price of SoFi. And remember, these are options. And options, you want to make your money and make your money, right? Like you don't want to be there forever. And I made the mistake of staying there forever with certain options. I mean, I was up $30,000 on SoFi at one point in 2023, and I didn't make my money. So for me, the one thing I'm skeptical about is how long this price action can last at this $8, $9 range, just because of what we've seen. And look, if it goes higher, then great. I'll be more than happy. SoFi, I want SoFi to do well, but I do want to make my money if I have the chance to make my money. So if I got a chance to make the money, let's make the money and let's keep going from there. Amit explains the stock market. You buy low, you sell high. That's what happens. No, but it's also really cool, dude. The other thing that's really cool to me is just the feeling of making a profit is very important in the stock market. I feel like if you're in the stock market, sometimes if the money is not in your account and you don't actually see a number that's higher than the number that you put in, you sometimes feel like it's rigged. You feel like it's a scam. You feel like you can never beat the big guys. And it's like, no, if you do your due diligence, if you have a thesis, if you understand market dynamics, if you go for the macro, you can actually make money in the stock market. And it doesn't have to be just because you held a stock for 10 years. And that's the best way to do it. But there are other ways that do that. So anytime there's a profit, and I'm lucky enough to make a profit, I remember like, no, this is a real thing. And you can keep getting better and better and better just as you learn, how it keeps going. Your sister have those options? Yeah, let me actually show you her position. My sister, I'm not selling her options so let me tell you why I'm not selling my sister's options yet. Because her options, there's no need to sell. And let me show you guys. So this is what my sister has on SoFi. This is what I bought for her. I doubled her money back in the summer and I haven't sold yet. She has $7, $12 calls. Okay. So the equity right now is $12,740. She's literally up 12 grand. Like that's not, there's no cost basis there because I doubled her money. I took out her capital, her initial, and now this is just house money. This could all go to zero and she would have not lost a single penny. So actually played it really well for my sister. Now, in the context of her returns, if SoFi is $12 by the end of the year, she will make, that says a max proc, 28,000. She will make about 28,000. So let's say we get rid of these around December 2024, she'll be up 21, 23,000. Right now, she's up 12,000. So for me, I'm like, okay, do I think SoFi can be $12 by the end of the year? And I don't know. 6 months ago, I would have absolutely said yes. But as I've seen SoFi stock action and how it gets traded by the market in the short float, I don't know if the market will give it a $12 range. But I'm more certain than not, it'll be at least $9 to $10. So let's assume SoFi is $9 around that time. I mean, she'll still make a decent amount of money, right? She'll make about 8 grand. Right now, she's at 12 grand. I think the risk to reward of SoFi being at least 10 or 11 by that time is better. If SoFi's at least 11, she'll make 17 if it's not at 12. And so she's in the money completely. There is almost no risk of her losing outside of SoFi falling to I mean, SoFi could go to zero. She would lose zero money because this is just house money. That's the best part when you can like actually when you take out your initial capital. So really, she has zero risk. But if she has zero risk, I think we should be a little bit less conservative and let it play out. Because if it does, if her strikes were at 15, I would sell right now. But her strikes are at 12. To get to 12, I don't think it's crazy. And if she gets to 12, she makes 30 grand. So that would be a nice little, birthday present to hand over to my sister. Her birthday is November 18th, so that would be guys. Okay, so we just got the Robinhood notification. So there you go. 60 SoFi call debit spreads executed, and we had 5,400. Let me know what you guys did. Did you guys sell? Did you buy any more? Where's SoFi right now? Let's get back to it. What things did you do? Obviously, if you have a long-term position, then that's fine. No need to sell here. But SoFi ran out 895, 17.39% on the day. Not bad at all in the context of SoFi. It's been able to do its thing. It's been able to do its thing right now, and it deserves to be up. It absolutely deserves to be up right now, given how the market is operating. CLSK is ripping. Okay, where's CLSK? CLSK. Wow. CleanSpark up 3.75% on the day. SoFi 893, Meta 398, Google 153, S&P. A quick announcement, guys, now that everyone's here. Dan Ives will be on the channel today, 5 p.m. Okay, 5 p.m. Eastern Standard Time. We'll have Mr. Dan Ives come on the channel. We will be discussing Tesla. We're discussing Microsoft, Apple. Big earnings week for everyone. We're gonna preview a bunch of earnings a little bit later today. So he'll be on with me for about 30 minutes. We're going to discuss everything, give his thoughts on what's going on with Tesla, and obviously we'll talk about Palantir, given Palantir has earnings next week as well. So for those that are interested, 5 p.m. Eastern, make sure you're here, and we'll have Dan on the channel. And he'll give us his thoughts on what's going on in the world of the equity markets. It's a very, very big week for the stock market. PayPal, 61.79. PayPal's flat. Tesla 184. Tesla's doing okay. Celsius is down 2% on the day. You know what I saw? I saw a tweet over the weekend. Celsius is up 32x since 2020. It's not to say they can't grow, but this is the one thing I'm scared about with Celsius is that the market cap is 1/5 of Monster. 1/5 of Monster. And Monster owns a very big portion of the energy drink market along with Red Bull. I know Celsius has massive distribution with Pepsi. I get it. But it's up 32x since 2020. If you're buying Celsius, I'm very curious. What are you in it for? Are you in it for a 2x, 3x, 4x, 1x? Like what? Like the market cap's 11 billion. Do you want the market cap to be, 22 billion? And at what point do you want that 22 billion for that 2x? Like, I just think Celsius is a little bit more of an opportunity cost than people think. I don't know if it doubles as easily. And if you're not in it for a double, then I don't know why you're in Celsius, honestly, because there's so many other names that can go up 30 or 40%. Like, why are you taking the risk with Celsius? I mean, sure, there's some big tech names that could probably go up 30% this year versus Celsius, even if they're not mega cap, large cap tech. So very curious what people think around Celsius and if it can actually double and how long it would take. Because if it doubles, it would be half of Monster's market cap. I don't know how much growth it really could get to justify being half of Monster when Monster owns a majority of the energy drink market. I don't know. It's a confusing one to me. It's a very confusing one to me. But, I'm still reading due diligence on it. It's not that I'm bearish. I'm just like really questioning the valuation. Definitely not buying it yet. Not that bullish, but not super bearish. I've read their growth is phenomenal, and I know they're expanding to Canada and Ireland. Growth is amazing. It justifies the PE. I just want to know if the stock market keeps up with it and if the valuation can get there as well. Palantir, let's talk about them. 1670 right now, up 2.1%. Palantir is going to be very exciting. They have earnings on February 5th. I've been doing a lot of research on Palantir over the weekend, thinking a lot more about Palantir. And look, I think Palantir is going to have a strong earnings if their guidance is good. I've been trying to figure out, I know I've been saying this for the past couple of weeks, and I probably sound like a broken record, like the guidance has to be the best. Over the weekend, I tried to figure out how would they guide. And the one conclusion I came to over the weekend is that the way Palantir guides in a way that a lot of us aren't expecting, meaning like we have just a really good guide on Palantir, is if they take into account DoD spending more money than you thought they were going to spend on AI. And so I talked with someone over the weekend. You guys might have caught that live stream on the channel. Adams. His ticker symbol is fuck. I keep saying ticker symbol. His username is Adams. His Palantir is Palantir. His name is Adam. Username is Palantir. He showed me a tweet by Sham that I hadn't seen over the weekend, and it was actually very interesting. Okay, so this is what Sham tweeted. he tweeted this right here. So look at this tweet. Very specific. The spend on software rounds down to 0.015% of US Army budget on C2 software, 0.2% of Department of Defense budget on AI. If Palantir guides that they believe the US government, because of the geopolitical instability that we're having and because of general trends in government defense, artificial intelligence, and machine learning, increases their amount of spend from 0.2 to say 0.5, which is more than a doubling, or 0.015 to 0.013, then or 0.2 to 0.03. You could imagine that be the growth lever for Palantir's government business and their overall top line revenue growth, because they are guiding that they believe the US government, the assumptions they're making, just like SoFi took into assumptions of 5% unemployment and 4 rate cuts, Palantir could take into assumptions that, hey, given the, analysis we've done on where the US government is spending money, we think the US government is going to spend XYZ dollars, which means we're going to be able to capture XYZ dollars, which is why we're raising our revenue guidance. That is the one thing that I've come to a conclusion to outside of the commercial success of AIP and the revenue growth on that side for how Palantir is able to maybe give us 25% top line revenue growth. Now, am I betting on it? No, which is why I'm doing 0 earnings plays. I'm not doing the earnings play I did on SoFi. I'm not doing that on Palantir because I'm just worried that guidance is going to come in below 25%. And if that's the case, then the stock's going to be, I think, flat or down. If it comes in at 25% or above, I think it's going to be very good earnings. There's a part of me that says that's going to happen, but the other part of me is like, dude, you got to be very conservative with this in the context of their commercial growth, because right now, they're still trying to figure out how to do the growth. I do have some calls on Palantir. I have $30 to $35 spreads on Palantir, but I bought like 30 of them a long time ago, and it's for 2026. That's not an earnings play to me. I mean, I think I put like $2,000 in those, and those are just like there. I'm probably just going to hold those until 2026. If Palantir gets to 30, that would be amazing. If not, then it's whatever. But outside of the core position, there's no earnings play I'm doing on Palantir, because to me, it's very black or white. If they do guidance high, we go up. If they do guidance low, we go down. SoFi's still holding that $9 range, 18.5% right now on SoFi. Not bad at all. Robinhood is up 1092, up 1% of the day. S&P 487 and Microsoft 408. Wow, Microsoft's up 1%. Wow. So yeah, I mean, in the context of Palantir, they've got to show the guidance, and that's going to be exciting on February 5th, and that's going to determine the stock. But this week we've got big tech, and big tech not only has to show the guidance, big tech has to show the numbers. Big tech has to show the money. If they don't show the money, then it's not going to do well. Franz, what when you're saying sold calls, you're talking about SoFi or Palantir? Can you clarify in the chat, and then I'll let you know. Because if it's about SoFi or Palantir, I'll give you the exact number. K Katana says, do you think your hood will beat earnings? Yes, I think Robinhood's gonna have a phenomenal earnings. The play I'm doing for Robinhood is on my Roth IRA. I'm buying $25 calls on Robinhood, and the goal is to sell them for double after earnings. The quick analysis there is that Robinhood $25 calls right now for January 2025 are 39 cents. They might be up a little bit today. When the stock was $13.15, those were at 90 cents. So that's a little bit more than a doubling. And the question is, do you think Robinhood can get to that $13, $14 range after earnings? I think they can. And, I'm not going to go through all the due diligence again. I've done a lot of due diligence over the past couple of weeks, but I think they can. If they don't, then they don't. Then you have another quarter for them to play out. But I think they can. And if they do, then I think Robinhood's going to do really well. And my Roth IRA might just double, over earnings. But if they don't, then, we're going to have to wait for another earnings for it to play out. So we'll see. We'll see what happens. Let's preview a little bit of big tech. We've got a lot of big tech going on. We've got Microsoft going on. We got Apple going on. Apple got upgraded today, going into from I'm forgetting which. I think Barclays upgraded them to 200. One of these bad boys upgraded Apple. And so they're getting a little bit of momentum. Apple, Amazon, Microsoft, Google, and Meta all have earnings this week. And so it's going to be a very, very exciting week to see what happens from there. The SoFi contracts. So I bought the SoFi contracts at 70 cents and I sold them at 90 cents. So about a 29% gain on those SoFi contracts. And I had 60 of them. So I bought 60 at 70 cents, spent 4,200, sold at 90 cents. So sold for 5,400. So I made a $1,200 profit. And then the Uncle Sam is going to take 20% of that eventually as well, unless I take some losses to off balance it. So we'll see throughout the year. Alan Crapo says, sold one of my SoFi options at 53% profit just now. Not bad. Not bad at all. SoFi 913. Look at that. SoFi $9.13. Look, I'm very happy for SoFi maintaining this momentum. The question is just over the coming days, can it sustain $9? And if it can, then we're going to be in a juicy spot for SoFi. Look, everything I saw in the earnings says there is zero reason SoFi deserves to be below $9. I mean, absolutely zero reason they deserve to be at $9. But it's really going to be a question of like, is the market willing to give them the momentum and keep it going? The biggest thing that I think is going to harm SoFi, if there was a thing, is big tech collapses this month, which not necessarily collapses, but it definitely doesn't have the strongest kind of, quarter. Right now, the options that I sold, by the way, I'm just looking at them right now. Let me pull those up. Well, 2025 is a different one. Let me pull up a different one. Is if February historically has not been good for big tech stocks. That's the problem. February historically has not been good for big tech stocks. Okay. And so if February has historically not been the best for big tech stocks, the question, becomes, does that affect the smaller tech stocks as well? Does that affect the SoFis of the world? Does that affect the Robinhoods of the world if big tech shits the bed? Like, I don't know. I mean, it's going to be a really interesting dynamic for how it plays out and if it is able to keep going. The options I just bought are at 96 cents. So the question is, if they would have filled right now, but they're at 6 cents above where I sold them. We got our resident CNBC contributor, Steve, calling. Let's get his thoughts on SoFi. I didn't even tell him to call, but he called. Steve, you're live with me on Amid CNBC, 857 people. How was earnings in your opinion?
Earnings were stellar.
Okay, Steve, can you have a little bit more excitement? There's 800 people here. They want to know your thoughts. You're a big SoFi guy. Can you give me a little bit more? How are earnings, Steve?
Earnings were freaking great. How about that?
Okay, give me your high-level thoughts. I got you on for like 5-6 minutes. What you got?
I need to go through the earnings call again. I need to go through everything. The fact that indirectly Noto told all the shorts you're screwed, considering that he gave several-year guidance.
Yep.
That doesn't typically happen. And the fact that he went out through 2026. And this is why I need to actually read the transcript, because I don't remember if he said through or to. I think he said through 2026. I think
he did. He did say 2026. Yeah, he did.
Yeah. So the fact that he's talking about 25% CAGR on revenue and around 80 cents of EPS for 2026 earnings, I mean, that puts its forward PE at 10 or less, 9 for 2026 earnings. I mean, I think it's going to be pretty hard for people to build a significant bear case around this company.
That's my thing, dude. I don't think there's of course there's a bear case, but with the guidance, with the guidance they issued, with being GAAP profitable, and with the revenue growth from particular sectors that are not as subject to the macroeconomic sector, that's why they're reducing their exposure to lending and increasing it to financial services and tech. I don't think there's a reason to be short on the company anymore.
So this is what I'll say. You can make a bear case for any company. I can make a bear case for Amazon or Apple. Whether it's realistic or not is a different story. You can make a bear case for SoFi, but all the bear points from the bear thesis is getting less and less
interesting
at this point.
Yeah, I agree.
It's just one of those things where the fact that they are continuing to see growth across the board, and there was something very specific that I'm going to address in an article about the tech platform, and I really need to reread a lot of things, but they said some things in there. I don't think people understand what they're doing. This corporate insight to credit card spending, that's the first, I don't know if it's the first step, but that's a significant step to really becoming a corporate hub for banking. It really is. I mean, I think that's going to go overlooked, and I'm going to highlight that in an article because they are probably hearing what some of the people that follow SoFi are saying about business. And I think they're going to make a big push into it over the next couple of years. And I think that's going to be a very big segment for them going forward.
Do you think that the financial services and tech sector growing at 50% year over year, do you think that's because Galileo and Technisys are finally coming into their prime and this is the year investors can expect some real momentum there?
I think they're going to win a lot of deals. I think people are going to be very surprised. The fact that they're going to be doing mutual funds, and I want more clarity on that. So I want to see if it's something I missed because I was in the car listening to this when I was driving into the office this morning. So I want to actually read the transcript, and I get everything better when I read it rather than listening to it. But like I've said to you before, I think the long-term goal is they're going to build an asset management firm, and they're going to become a big player in 401ks and retirement plans and actually a full financial service company. The way Bank of America has Merrill Lynch, the way that Chase and JP Morgan are together, I think they're going to build that out. And it's smart because not only are you going to have your own mutual funds and ETFs that you're getting a very low percentage on AUM on, but when you are a financial service company and you are doing 401ks, you get the asset management fee on top of that also. So if they're able to put people in their own S&P index fund, they get to double dip because they'll get that little VIG on the actual ETF management, and then they'll get the VIG on the overall corporate 401.
Right.
So I think it's going to be very interesting over the next couple of years what happens.
I think so too. The stock's at 924 right now. I think the reason it's getting the momentum is because the street's also realizing that the bear case is. The guidance they gave. I mean, that EBITDA as well. I mean, the EBITDA margin's 30%. The last couple quarters.
Yeah, remember, they're sandbagging.
Yeah. No, they always sandbag too. I mean,
that's Noto's MO because Noto is an investment banker at heart. He knows what you need to do to move numbers. He is not a person that is going to overpromise and just deliver. He's going to underpromise and smash because that's what moves the needle when it comes to price. And let's not forget, and people aren't putting two and two together. I don't think. I shouldn't say that because I haven't talked to anybody or listened to anything yet. But why did he give guidance 2026? Oh, because he has RSUs vesting in June.
Yeah.
2026. At 25, 35, and 45.
That's true.
There's a reason why he gave guidance that far out. He's probably sick of it. He's probably sick of hearing all the bear cases and reading all the bear cases about things that are just not true because pretty much everything that they have said over the past year has turned out to be inaccurate because they're not taking management at their word.
Correct.
So we'll see. I mean, look, you can make a bear case. I just think it's getting less likely that the bear case occurs, especially that they're GAAP profitable now. What's the next thing that they're going to set? What's the next thing? I mean, they guided for full year GAAP profitability in 2024, and they guided for 80 cents or around 80 cents in 2026. I mean, they gave you the guidance this year in forward guidance. I mean, it's pretty easy to make the PE projections, and for a growth company growing at this rate, 9 times or 9.5 times forward PE for 2026 is pretty damn cheap.
Let me ask this question, and then I can get you out of here. Now, the stock's at 925. We've seen this story happen many, many times where the stock runs, maybe stays there.
I don't think it's selling off.
You don't think it's selling off?
And
okay.
I could be wrong. Look, it could go back to 750 tomorrow. Obviously, people could be profit taking. I'll buy more. So I don't
think it's going to sell off either. I just don't know. I mean, I think if it sells off to 880, I don't think anyone can be super mad.
Yeah,
but I don't know if we're going back to 730 again. I don't think so.
Yeah, it could come back down. Look, there's other things that can happen, right? Powell speaks on Wednesday. He could obliterate the market. He could raise rates. Take the intangibles and take the unpredictables that we don't know out of the equation for a minute because nobody can predict that stuff. Just from a fundamental basis and from what they said, I think it's less likely that SoFi repeats its previous MO with it just gets pumped and then sold off for the profit.
Yeah.
I just feel like there's less of a reason for that to happen at this point.
I agree. 100%. I think it's definitely less of a reason for that to happen.
We'll see. I mean, I think everything is going its way, and 2024 is going to be the first year everything fires on all cylinders. It's going to be a very interesting thing.
All right, Steve. Thank you so much. I'll see you on our podcast later this week.
Yeah, call me when you're done with this.
Okay, gotcha.
All right, bye.
All right, folks. SoFi 923 right now. We're seeing a ton of momentum here. So not bad at all. Now, again, guys, the reason I sold, and I just want to clarify this right now, is because with options, you have to make your money and then get out. Like, this is the one thing I've learned. So for anyone's like, oh, you could have made, an extra $10 a contract and you could have made an extra $600. Like, yeah, you could have, but you don't know. Like with this type of shit, you have to make your money and then leave. And that's it. I mean, like sometimes you make your money, sometimes you don't. Along with the fact that these don't always go. Like right now on Robinhood, it's saying you could maybe get them filled at 99 cents. 2 seconds ago, it was maybe getting filled at 92 cents. Like this stuff is very volatile. And so in the context of that, you kind of just got to make it and go and then keep going from there and run. And the reason I did it early, Francis, yes, but not the first 15 minutes in the market, is because you don't know what ends up happening, right? So let's say SoFi goes to $12 today or $10. Like that's great. That's fine. But no one knows. That's the thing. Just no one knows. And so you got to do whatever you got to do and keep going from there. Amit, why not sell 1/4 of your sister SoFi? Because hers, remember, she has a $12 strike and it expires at the end of the year, early next year. Hers, there's no reason to sell because hers, and again, it's all house money. She's not risking anything here. So for her, I want to let that bad boy, go to 10 or 12 by the end of the year and just let it play out. But for me, I just wanted to make my money and move on from there. So we were able to make some money. Not bad at all. And keep going well. Earnings did do well. Correct. Earnings did do well. Now it's profitable. It won't sell off as quickly, just like Palantir did before. This is going to be up to the market, dude. We got to see. Like, I have no idea. We have no clue at this point how the market's interpreting this. Obviously, it's up right now 22%, but we've been through this before. We've seen this happen. I agree with Steve. I don't think it's going to sell off as much as some of these other companies have sold off, or how much it's sold off previously before. But you also got to think, well, it's up 22%. You still have a short float and people want to take their profit. So I just don't know, right? And if it goes up, great. If it doesn't go up, that's fine. But you got to also remember when it comes to options, this is what I've learned. And this is why you can't let anyone make you feel bad about this. Profit is profit. No one went broke taking a profit, especially when it's something as volatile as the options market. So whenever you have a chance to make your money, you make your money and you move on from there. Otherwise you're going to end up, you're going to have a lot of regret. I mean, when I was up 30,000, I didn't take my profits, right? So it's like at some point you have to remember how to actually take your profits. From Schwab, JKL says, this security is currently hard to borrow. Short sale orders for HTB securities may not be accepted during non-market hours due to short sale locate requirements. That means there might be a little bit of short covering happening right now. That means there might be some covering happening right now on those. What was your expiration date? 2026. Expiration date was 2026. Again, guys, these were not something that I wanted to hold for a long time. Just walking through my psychology. You can agree or disagree. Quite frankly, it doesn't matter to me. Like, these are something that I wanted to make a short-term gain on within 2 weeks. And that's what I did. The goal was not to, if I wanted to hold these till 2026, I would put $15,000 into those options. I don't have, a $4,000 position in options and hold it till 2 years. Like, that's just not worth it. The money is like, the money could be added to better positions and solidify them. This was something that was meant to say, hey, can we make a couple grand on this within, a couple weeks and on earnings? And that's what happened. If I actually wanted to hold till 2026 for options, then minimum, it would be at least 10K, 15K in there for there. So that would go from there. Why did you sell all? You could have sold half because I wanted to sell all. I wanted to make all the money. Why did you take profits of Palantir at 21? So again, Palantir and I have a very special relationship. Me and Palantir, it's just hard for me to sell Palantir. So that's like I could sell Robinhood, I could sell SoFi. Palantir is like one of those that, and I was up. I mean, you guys know how much I was up. You guys know I have 3,000 shares, $15 average. So I was up a decent amount at 21, but Palantir is the one that I just don't touch. I say, all right, just let it be. And we'll keep going from there. So not too bad. Ty Gordon says, how much you don't dive in hand for all eternity. Yeah, dude, that's my thing. And look, in hindsight, it's very easy to be like, oh, why didn't you wait? Why didn't you make an extra money? But it's like, dude, in the moment, you have to try to take what the market's giving you. And there's not a lot of opportunities when you're investing where the market's actually giving you profits. I was talking to Sachin the other day. I'm not going to give you the exact numbers, but Sachin made a very big bet on Robinhood when it was at $8. And he ended up selling a little too early when Robinhood started to rally. I mean, he missed out on a decent chunk of profits if he had just waited a couple of days, quite frankly, on Robinhood's rally from 8 to 13. That was back in December. But he still made his money because at the end of the day, you have to make your money. You cannot like wait for anything to happen. You don't know. It could have tanked after, the first 15 minutes. You just have no idea. And so it is what it is. You make your money and you keep going from there. And you got to be blessed that you even have the opportunity to know, how to make certain money in different elements of the market. Cool comment guy says Palantir going to 28 or 32 by the end of the year. I think Palantir can easily be at least $20 by the end of the year if they have sustained growth. If it gets to, higher than 25% top line growth, I think, yes, it can get to 28, 32. Remember, Karp said $60 billion company. That's about a $30 share price. So I think Karp at the Davos Summit, when he said, I think my company can be worth 60 billion, he's very calculated the way he says his words. I don't think he was messing around when he said that. His lawyers probably hated him, but Karp acts in a certain way when he talks about, numbers and things of that nature. So I think it's very possible. Why didn't you buy Microsoft in 1985? Yeah, I should have. I should. Do you have any old coins? No old coins. I don't like any old coins. Don't really know how to mess with old coins, so no old coins for me. Vishal says I want to DM you something about Palantir. Yeah, hit me up on Twitter, DM me at Admitted Investing. Why don't you take profits for your sister? Again, let me say it. My sister's money, let me show the position again. It is literally, it's up even more now. It's literally house money. She does not, there's no risk involved in this. This 13,000 you're seeing, this is all profit because we took out our initial. This is back in July of 2023. So these were worth 240 when I sold it for her in July. She had 140 of these. Now she has 70. So we sold half of it. And again, if you just simulate the returns, if SoFi is $12 by the end of the year, she's going to make close to 25 grand. So this is the one that is not meant to be selling early, the one where I have 4,200 on the line and I don't want to lose any of that money and it's a short-term bet. That's the one you want to take your money and run. But something like this where she has literally zero risk. I mean, if I think SoFi is at least $12 by October, November, she's making 20 grand at least. So, and I think $12 is reasonable given the earnings that we saw today. I think it's very reasonable. So, yeah, we'll have that position play out and see where it goes from there. SoFi now $9.18, up 20% on the day. So still holding that $9 range. It's down from $9.35, so it got sold off a little bit at $9.35, but it is still up on the day right now. Okay. So, Chima says you made a great play on SoFi. I may get that money. Chima, thank you for being in the chat. I appreciate it. Sell half and buy PayPal earnings play. Dude, PayPal is I did an earnings play on SoFi because it's SoFi and I trust in Anthony Noto. I don't trust in Alex Chris yet, especially not after that whole, we're having an event that's going to shock the world. And by the way, the event that's shocking the world is literally an event that's that's pre-recorded on YouTube, dude. Like that's tough. So I don't trust Alex Chris yet, but we'll see. SoFi right now, $9 and where are we at? $9.04. Okay, so it's selling off a little bit. Still up 18% of the day, but $9.04 right now. And we'll get back to SoFi in a second. Let's listen to what Dan Ives had to say about Tesla. He talked about it over the weekend. Let's hear his thoughts. He'll be on the channel again today, a little bit later. Let's see his Q3 earnings recap. And then we'll keep going from there. I'll talk about Tesla, and then we'll do a Microsoft, Meta, Amazon preview as well. Here's Dan Ives on Tesla.
Tesla down 12% since reporting that big Q4 earnings miss the other day. Warning of a slowdown in vehicle volume growth this year as well. Joining me now at Post 9, Wedbush's analyst Dan Ives. He was with me the other day, just ahead of that report. He doubled down on his bullish case for that company. So he's back. Welcome back.
Great.
Did you come back today to say I was wrong?
All right, man. Look, we talked about we were dead wrong in terms of the call into the quarter. I'd almost go and say almost 25 years doing it, probably a top 5 worst call that we've had going into a quarter. We thought, as we talked about, that they'd put the line in the sand for margins. Price cuts are mostly over. And instead, it was a circus show from a conference call. They left the door open for price cuts, didn't give guidance. Musk talked about the 25% in terms of the ownership and the AI, and it went off the rails. And that's why we're here today, basically, looking at it and thinking like, okay, now what's the step forward? Put out that top 10 list, which we believe could be an inflection point to how we ultimately get higher.
Are you reassessing essentially now everything about this company going forward?
Look, we took it off top picks list because in the near term, from a catalyst perspective, no smoke and mirror. I mean, you don't have the catalyst where you could ultimately say, this is going to outperform in the next 30 days, 60 days. Now, in terms of the long-term thesis, look, we remain firmly bullish because it's my view, and it goes back to similar to Netflix in 11 with the streaming. You go back to Jobs in 07 with iPhone. We've been through so many different evolutions of companies. I think view this more as an evolution into the next phase with AI, and I view the mass market vehicle sub $30,000. So we don't throw that out, but no doubt in the near term, I mean, it's been a disaster this week.
I look at your rate. You still haven't outperformed, right? So you haven't taken that. How do you fundamentally have an outperform at 1.2 trillion market cap and an outperform now that it's down to 581 billion?
Sure.
It's almost been cut in half. But how do you still have an outperform on it?
Yeah, it's a great question. It's my view that going forward, the margin story, it's going to trough. So I view like when they cut costs, you could actually start to get margin expansion 20, 30%. Then all of a sudden $5 of earnings becomes 8 to 10 when you look out in the next 2 years, especially on AI. I mean, our view here is this could be the best long-term AI play out there. And that's what we talk about. I think it's ultimately going to form into some sort of holding structure from an AI perspective with Optimus, Dojo, and others that must
the
take
best
this.
AI play out there. I mean, what are you talking about in terms of automakers? You're talking in total, like against Microsoft?
So I'm saying longer term from an automotive and from where they could go with Dojo and Optimus, you could argue that longer term, this is going to turn to much more of a broader company. Now, as we've talked about, the AI revolution is led by the godfather of AI, Jensen, NVIDIA, Microsoft, everything we're seeing in tech. But for Tesla to misevaluate that this will be an AI story, this will be what I view as almost, I'll call it an air pocket, and it's more than an air pocket, but I think we are going to see at one point 2.5, 3 million vehicles per year. And at that point, Scott, we look back at this is more the opportunity of very bad bump in the road rather than the time that this is a structural what I'd say change in the story.
Okay. So, I mean, look, Dan Ives is pretty bullish on Tesla long-term. He'll be on the channel today. We'll get a better understanding of what he has to say. In general, I think his argument is probably correct around Optimus, the robot, FSD, all that stuff. You know, we can talk about that for days. But he's probably right in the short term. SoFi right now, 918, up 20%. Let's go to Tesla. In the short term, Tesla up 1%. They are going to struggle from the fact that they have not given guidance on margins and on volume growth. Now, the question becomes, how much do they struggle, right? Do they really get to a point where it's bad? And I think it's a question of how bad does the macro evolve into and how quick are we to get interest rates? Because if we don't get those soon, in terms of those cuts, they are, they're definitely not going to make it easier for people to end up buying or financing cars. Palantir, 1684, up 3% on the day. I have not started to buy the Tesla dip yet. I don't think it's wrong to dip your toes into the Tesla dip, but I don't think it's time to go balls deep into the Tesla dip because, again, if it goes back to 220 or 230, that's pure retail mania. There's nothing fundamental to get it there. Because if you look at the business right now, just if you take out all the dream scenarios, which are probably closer to reality than dreams, but if you take those out, the automotive business is struggling with China, and it's also struggling with margins. And the company themselves said the growth rate will be significantly lower, notably lower than what they had in the past, which is okay because they're being real with us. But it means that 2024 might be a year where Tesla's just doing what they need to do. And then 2025, the story starts playing out even more. So from that perspective, I don't know if this is the best time to get in. The other thing you have to think about, the S&P 500 is at all-time highs, 487 right now, 48. And QQQ is also at all-time highs at 424. We tend to see a 10% pullback in the broader indices at least once every year. That hasn't happened yet. I know we're 1 month into the year, so we'll see what happens. And February on record has been the worst year for tech, or the worst month for tech stocks. CleanSpark, by the way, up at 7.74%, trying to close in on $9 along with SoFi at 9.26. So if that's the case, I mean, you just got to ask yourself, I don't know if Tesla is going to be able to put up when the S&P drops or when some of these broader tech companies drop. Now, if the Magnificent Seven remain magnificent all year, then it's going to be very exciting because maybe this really is the Tesla dip, because at some point it has nowhere to go but up. If Nvidia's at $800, Tesla's not going to be stuck at 185. But if Nvidia comes back down to 500, which I don't think is going to happen, but I mean, you never know. If there's a 10% pullback, maybe get to 550, something like that. Even if it's short-lived, that could happen. That's where Tesla could have max pain, and that's where the entry really becomes exciting, at the 150-ish, 160-ish level. So no one knows exactly where it's going to go, but I do think 185 is still paying a little bit too much right now, given how the price of it is interacting. But it could obviously to come lower. You don't time a company like Tesla, in my opinion. Well, I agree, but the problem is, remember, if you bought it at 2020, I mean, you basically had 3 years of no gains on Tesla. So the timing on a company like this, even if you're holding it for the long term, it does matter to an extent. Same thing with Palantir, dude. Like, my average of 15 sucks. Like, I wish I was a little bit less early. And that means the gains are not as strong as people that have averages below 10 that got in, while I was making videos when, at March of 2023 and people were buying it, I was reducing my average. So I do think you want to have a decent entry point, even if, but I don't think DCAing at 185 is bad. I just don't think if you want to buy 100 shares, maybe 5 or 10 shares right now at 185 is reasonable, but not 50, even if you have the cash for it, in my opinion. And if you have to pay 190 because it starts going up, or 195, that's not, the biggest deal in the world. But if you get to pay 140, that is a lot better. Jay Kim says, I bought Nvidia at 146 and sold at 200. I thought it was a genius. Yeah, that's hard. It's not timing, it's respecting valuation. 100%. That's actually, dude, Thomas, that's a great quote. It's not timing, it's respecting the valuation. I'm actually stealing that, dude. I love that. Next time someone says that, and look, if I'm timing the market, I'll tell you I'm timing the market. But if I'm not actually timing, if I'm respecting the valuation, then that's what I'm going to say. I'm going to say, hey, man, it's not timing. It's respecting a valuation. Just sounds so much cooler, dude. Just sounds like it sounds like you know what you're talking about. Okay, those options that I sold for SoFi right now, they're at $95. They're at $95, and I sold them at 90. And right now, the likelihood that they fill is very low. So let me show you guys what I'm looking at right here. These are those options, $12.17 spread. You see on Robinhood where it says low likelihood. You see that right there? When I put in 95 cents. Low likelihood means that the ask is $1.06. The bid is 84 cents. So 95 is the middle. Low fill likelihood, in my experience, 85% of the time it doesn't fill. And the reason it doesn't fill is because you're smack dab in the middle, and unless there is a massive move to the upside, they're not going to fill your orders, right? So for this to get filled at 95 cents, I would imagine SoFi that's at 9.29. Because now someone is buying it at 9.29, which means if they're buying this option that I would have been theoretically selling for 95 cents while SoFi is $9.30, they want SoFi to be $10 and $11 and $12. And you got to ask yourself, how much demand is there in the options market to provide liquidity for someone who's ready to buy the option that I bought when it was at 7.30 and 9.30, expecting it to go to 11.30? Well, Robinhood's telling me there's a low likelihood right now. Okay. And so that's why you try to get out of these options as soon as you can, and you have some defined strategy. The other reason I'm actually proud of myself today is because last night at like 2 a.m., by the way, last night was weird. I slept at 8 o'clock and I woke up at 12, and then I didn't sleep the whole night. And I slept for like an hour at 4 a.m. I don't know why I slept so early. I thought I was being responsible sleeping early. I was like, oh, I'll sleep at 8. I'll wake up at 4. It's like, no, I woke up at 12 and then I couldn't fall asleep. But I got a bunch of work done from 12 to 4. And from 12 to 4, I was trying to think of my exit strategy. And I was like, okay, so if there's a move this way and there it goes this way, then let's just put a limit order here. Maybe that's too conservative, too risky. And then, I at least thought about it, which is what I'm very happy about, because I came into the morning with a lot of clarity for what I wanted to do. So we still have a low likelihood here. Now I'm going to change the price. I'm going to go from 95 cents to 85 cents. Even that is still a low likelihood, meaning it wouldn't fill. I'm going to go to 70 cents. Wow. Even that's a low likelihood of it closing. And see that. And now look, the total cost, you see how it says $1.07? That's what someone would have to pay for this to fill if they were buying it. But for it to close, you have to get someone ready to actually take it off your backs. And that's where it's tough to see if it goes there, right? Now, if I put this at 50, then you get a higher chance for it to close. But at 96, even then, it's still a little bit of a low likelihood. So that's the tough part with these options, right? It's like you got to get out when you can and take your money, and $1,200 is nothing to, get mad about or upset about. But it's also a question of, is the market willing to give you the liquidity that you want? And that is the broader question here. Maybe they're very, and that's the other, no, Franz, that's the other thing. The reason I also was happy my order got filled, you guys saw me ecstatic, is because these are for 2026, dude. These are not for February 4th, which is, well, let me show you right now. I actually found this new website over the weekend. It's called optioncharts.io. Have you guys heard of this thing? This website is fucking cool, dude. This is a cool website. That's the other reason I was really happy they filled, because who's buying 2026 options right now? Like, not a lot of people. So the options market, those leaps, to get them to fill is hard because people don't want to bet that long term. Like, my philosophy is betting long term because I was taught by Chris and that's his philosophy. But in terms of most option contracts, they usually end earlier. Yeah, so look at this. Look at this. Look at what we got right now. So this is the option expiration for SoFi right now. And today, let's go a little bit. Let me refresh this. Okay, so we're going to go to just calls, and we're going to go to open interest on the calls. Or sorry, here we go. As you can see right here, the SoFi February 16th, 2024 call for, what is it, $8? Okay, this website's being a little, oh, here it is. Here's the better. Sorry, I had to scroll down. So let's, February 2nd, $12 had 74,000 contracts open. You see this right here, 74,000. This is what a lot of people were betting on, right? Those options are probably up a lot right now. Let me actually check it right now on Robinhood. So SoFi February 2nd, $12 calls. Yeah, I mean, they're up. They're up a lot right now. They're up a lot. And the $10 calls are up. The $8 calls are up 130%. Let me show you that right here. The $8 calls, see that $8 call right there? 130%. So if you bought SoFi $8 calls before February 2nd, which is right now, it's January 29th. So let's say you bought them last week, you're up 130% on your money. So if you put in 50,000, you're up 50,000, even more, 135%. But you may be saying, oh, well, why didn't I do that? Why didn't I put 50,000 into this $8 call? So if I was at 730, there, it would probably go to $8. The problem is it has to go to $8. Right now it's at $9. That's why it's doing well. And it expires in a week. So if earnings sucks, then your contract, you would have lost 50 grand, right? Because it's not going to pump to $8 if earnings sucks, but going into February 4th, which is 5 days away. This is why I say I'm not able to time it. That I think is actually timing it. It's strategic gambling and timing. But if you give yourself 2 years, well, you're not really timing it. You're giving yourself a lot of time to get that liquidity. But your options, on the other hand, aren't going to fill as much as they would have filled if they were expiring next week, because you got a ton of gamblers and algorithms that are betting on this thing to expire in 1 week versus in 2 years from now, which is why it's harder to find liquidity on some of these options as well. So, that's another reason I think it was nice to see those fill today. I mean, so January 2025 would have gotten you more gains? No. January 2020, well, yes, technically yes, because 2025 is earlier than 2026. So yes. But February 8th, 2024 or February 4th, 2024 would have gotten me the most gains. But I'm not willing to do those. Now, Sachin made a shit ton of money today. Sachin's up probably almost 200% because he bet on January. Robinhood, by the way, $11 up 2% a day. He bet on February 2nd, 2024, $8 strikes. Stock's at 930. He's making a lot of money. Now, Sachin's more experienced in options than me. He's willing to take those risks. I'm not willing to take those risks, and he has a lot more money he's playing with. So he could have lost a lot of money as well. But, this is the nature of this game and how it plays out. I just keep staying to the 2 years, a year and a half out, because otherwise it's a little bit too much. You should have done January 2025. Now, remember, January 2025, my premium would have been more expensive as well. So this is the other thing you have to think about when options. If you're paying for it depends, right? Because it might have been cheaper because it's an earlier expiration date. But yeah, it actually might have been cheaper. The question then is, yeah, no, you're probably right. The only thing is I just didn't want to risk it until January 2025 because I don't know where it would have gone, especially because I was picking $12 strike, and that's a little bit more risky than $8 strike. If I picked an $8 strike for January 2025, it would have been way more expensive than the $12 strike for January 2026. Because then the strike, there's so much disparity between the strike prices that the expiration date doesn't matter as much, because you're taking way less risk by saying it'll go to $8 versus $12. Oh, wow. Citadel CEO is going to be talking tomorrow. Ken Griffin. Okay, so we have a lot of stuff happening there. We have FOMC meeting this week. Mag 7 right now. Nvidia's up, Tesla's up, Amazon's up, Google's down just a little bit. Meta $399, Microsoft continuing to pump $406. There's a lot going into Microsoft earning expectations. Primarily, the big thing is 15% year-over-year top line growth. I think they need to have at least 15 to 20% year-over-year growth on guidance. And I know that's crazy to say because Microsoft's such a big company, but they need to be able to have good guidance, given they're convincing the world that AI and their partnership with OpenAI is going to, increase in massive amounts of revenue, especially when it comes to Copilot. So we need to see that do well. And then in the context of Apple, we need to see that Vision Pro actually selling. If we don't see that Vision Pro actually selling in terms of at least the pre-orders and Apple giving some more clarity there, I think it's going to be harder for the market to justify that, Apple deserves their premium as well, even though Apple got upgraded today by a bunch of different firms. Adam IC says, I loved how little Noto said AI. Yeah, he said machine learning once. Machine learning was there once. And I was like, oh, there we go. We got some tech mention. But Apple's going to have to show Vision Pro's doing some selling. Microsoft's going to have to show that Copilot, their $30 subscription, is actually going to scale to the, $16 billion in annualized revenue the street thinks they can get. I mean, the street literally thinks if 10% of the 430 million Office suite users convert to Copilot, that brings in 16 billion of top line revenue. They increased Microsoft's market cap by about 80 billion. So they put a 5x multiple. At this point, it's like 95 billion because that was a month ago on the expected gains from Copilot. Like if Copilot is not really selling or they're not issuing guidance for Copilot, which is again, Microsoft's AI companion at $30 a month. If they don't show that that's really going to hit the masses, the street's going to be upset. So the street has given it the premium because they think that's going to happen. And that's why that earnings call, I think, is going to probably be the most important. That's their earnings call is probably going to be more important than Google, quite frankly. As you can see right here, I mean, let's look at the 1 year on Microsoft. Microsoft was at $217. Wow. January 2023. January 2023 was such an amazing time to buy tech stocks. I was mainly buying Palantir, but I know a lot of people that got into the queues. I mean, $220. You basically doubled in a year. Absolutely incredible. Same thing with Google. Google was at like 85. I mean, January was just an amazing time last year. But now January 2024 is different. Now you're at all-time highs. And you're at all-time highs, quite frankly, without really justifying it. I mean, you've not just reverted to the mean, you've surpassed the mean, and you're at an all-time high. And Nvidia is the only company in my calculations that has actually justified that. The rest of them got a lot of work to do this quarter. So we're gonna see. We're gonna see where it goes from there, and how they end up doing it. EtherSquare says ARK Invest is using Foundry. Yeah, I saw this tweet. This was a really cool tweet. I think EtherSquare did some basically like digging for the link. I think ARK using Foundry makes a lot of sense, dude. There's a ton of investment firms, the New York Stock Exchange. There's one in Texas. I'm forgetting their name, but CAZ, C-A-Z. I was trying to remember it on Friday and I couldn't remember. I said Chad on the market close. I was like, oh, Chad investment firm is using that. I was like, no, that's wrong. It's CAZ, C-A-Z. So Ether says ARK has been using Foundry because they have their own Palantir link. arkinvest.palantirfoundry.com. So here is the link. And as you can see, it's working. ARK Invest, let me put in the chat for anyone who wants to check it out. These links have historically been correct. We found out Novartis was using this. We found out Pepsi was using this. We found out United Airlines was using, like a bunch of companies that have used this. It's always worked. It makes a lot of sense for Kathy to use Foundry and AIP because Palantir and the financial services is a absolute game changer when you incorporate AI in terms of the risk mitigation and overall investment management operations that a fund has to go through. There's no reason they shouldn't use them, and they own the stock, so you might as well use the product that you own as well. They have to use Foundry. They are investors in Palantir. What better reason to explore the product than be a consumer? Yeah, I agree. 100% agree. And look, she had that meeting with Shyam Shankar, that podcast. That podcast, I think, actually opened up two things. It opened up her being less likely to sell. It opened up her being more likely to listen to the company and take them seriously when they talk about AI, given ARK thinks AI is an $80 trillion market in the next 10 years. And I think it's making them more likely to want to engage with the team at Palantir. They're one of the bigger institutions that has a lot of retail influence that's buying the stock. And so Palantir definitely wants them on their cap table. And so I think they're going to have a productive relationship together as well. SoFi 932 holding on to some gains, up 20% on the day. SoFi not bad at 932 right now on the stock. What about investing in companies who are using Palantir products? I stay away from it. People have said, why don't you invest in like the SPACs and all the companies? I just rather invest in Palantir, quite frankly. Like, I mean, investing in like big tech companies that are using Palantir, like, I don't know, there's a United Airlines, like that's fine, but you have to be bullish on the airline sector, right? I don't think Palantir is an investment thesis for other companies. I think it helps them increase their margins and decrease their expenses. But at the end of the day, you know, Palantir is the company to bet on. That's, you know, being the operating system, the central hub for doing all that. So I think that's, you know, the broader company that I would want to bet on than just the companies they, you know, help. Okay, so let's look at some of the other sectors. We have Palantir up 3.18% of the day. Not bad at all. Palantir at 1687, trying to close into that $17 level. FinTech is up. SoFi 930, Robinhood 1102, Affirm 43, PayPal 62, Square 67, Coinbase 131. Not bad at all. So that's doing well. Let's do semis. Semis are doing okay today. Some of them are red. Intel, damn, Intel is down another 1%. Wow. Intel fell 12% last week. Now they're down another 1.2%. So they're stuck. Where's Enphase? You guys mentioned Enphase. Enphase 105. I have no plans to buy Enphase. I think solar is screwed until interest rates come down. And even when interest rates do come down, even if the market gives Enphase some momentum, they're not going to be down enough for consumers to buy solar panels. Even Tesla, if you guys saw the Tesla numbers in the deck, I think it was on like slide 15. Their solar business sucked this quarter. Like it did not do good. And so I think solar is you want to be it's a little scary to bet on solar right now. And so, and then they reduced their guidance, Enphase, the company themselves, a couple of weeks ago. Now they're in India. They're meeting with the Prime Minister Modi right now, and they're, you know, doing a bunch of PR. But in terms of the actual business, I think until rates come down, it's going to be tough to get into it. Now, granted, is it undervalued? Yes, but it's undervalued over 5-6 years, not in the short term, because it's going to take a while for rates to come down and for consumers to easily want to buy. Remember, Enphase has 48% margins, hardware margins, which are exceptional, but they're going to do $300 million next quarter in revenue. They were doing $750 million 3 quarters ago. The business has changed because of the rate cycle. That is something that's undeniable. And so it's going to take a while. CleanSpark up 8% of the day. That is correct. CleanSpark is up, baby. We still have those CleanSpark options. We're holding on to Bitcoin, getting to all-time highs for these options to print, and we'll see what happens with Bitcoin. Bitcoin doing well. It's up from that $38,000 range up to about 42. So not bad. We got Tanner in the chat. Congrats on SoFi earnings. Tanner, congrats to you, man. I mean, you've got a much heavier position than me on SoFi. So SoFi, look at that, $9.26, up 21% on the day. Not bad at all. SoFi, obviously, phenomenal earnings today. Noto's on CNBC right now. Is he? I have YouTube TV for a reason. We can watch this shit if he's live. Let's see. Is he actually live? Is he live? This is the only reason I have this stupid YouTube TV subscription. Okay, they're on commercial break right now. They're on commercial break. Let me know if anyone sees is actually there. That's so weird, dude. They always I feel like every time I log on, they're on commercial break. Oh, is it back? Oh, it's back. Okay. It's back. Coming on after the break. Oh, he's coming on after the break. Okay. So I have it pulled up. So if he's coming on after the break, then we'll watch him live. Yeah, let's watch him live. Let's watch him live. Let's do it live. Solar is expensive for India, which has per capita income of approximately $2,500. That's correct. Solar is expensive. Ankit, you're right. But Enphase definitely knows that manufacturing their microinverters will be cheaper in India, and they know the Indian market from a not a residential but from a commercial perspective is going to have increased margins for them and definitely a lot of opportunity for growth. So I would imagine they're trying to get into India simply because of the fact that, well, India is a big market and India needs a lot of energy. And if they can secure some commercial partnerships, even if not residential, then that would obviously be very good for Encase. I think it would be live in half an hour, not now. All right, so I guess we're not going to get him live. They should have him live right now, dude. It's like right after earnings. They do tend to do these interviews at 11, though. You're right. They do tend to do these interviews at 11. Okay, so we'll react to him for the market close, regardless. We'll do it on the market close instead. Commercial doesn't really use microinverters. Really? But commercials uses solar panels, and solar panels have microinverters. So maybe I'm wrong on that, but I would imagine that any commercial entity that uses solar panels has to have some microinverters in front of them. Commercial mainly uses central and string inverters. Interesting. Okay. Well, yeah, that's the bear case for India then. If that residential is using microinverters and that's where Enphase's margin is, then they're not going to be able to sell to commercial as much. String inverters equal commercial. Interesting. Okay. Yeah. So I think a lot of the PR they're doing in India is a ton of PR. That's all it is, right? I mean, like, it's good stuff. Someone was sending me some of their stuff, but I mean, and I love India. I'm Indian. That's awesome. But at the end of the day, I mean, it's like we need more than just PR when it comes to India going well. Here's one of the pictures that I found here that I want to show you guys. This is Narendra Modi, I think, interacting with one of their products. Yeah, there you go. That's one of the Enphase products, and that's Modi. Commercial tends to be larger installations, and String Central is better for those. Wow, I didn't know that. You guys taught me something today. I thought microinverters were universal across commercial and residential. I did not know microinverters are specific to residential and String is specific to commercial. I didn't know that. It's very interesting. All right, cool. Are you Indian? Yes, I am Indian. I was born in America, but I am Indian. Okay, one last look at equities, and then we'll get out of here for the day. We'll see how these stocks are doing. SoFi, $9.29, maintaining that $9, $30 range, up 22% of the day. Not bad. CleanSpark, $8.73, up 9%. Enphase, up 0.35%. Palantir, up 2.84%. Qs are up a little bit. S&P is up just a little bit. Tesla, 186. Tesla up almost 2%. That's actually not too bad. And then the big earnings we had today, SoFi, $9.28. Rest of the big earnings will be throughout the rest of the week. I'll be live streaming all of them on this channel. So we got a big week of live streams. Microsoft right now, 406. Robinhood, I think, at $11. Robinhood, 1102, up 2% of the day. And Palantir at 1682, up 2.84%. Dan Ives will be on the channel, 5 p.m. Eastern Standard Time. So for those that want to hear his thoughts, he'll be here on the channel. We'll be chopping up about Tesla. We'll be talking about Microsoft and Apple. Obviously talking about Palantir since those earnings are coming up. And so he'll be here 5 p.m. for 30 minutes, and we'll be discussing more with Dan Ives on everything going on with the market and with all these big tech earnings that we have coming up. It's going to be an exciting week, guys. It's going to be a very exciting week. I mean, this week, I think, determines at least the trajectory for the next couple months. We have FOMC on Wednesday. That's going to be huge. They're probably going to pause, but Jerome Powell is going to say certain words, and we're going to react to all of his syllables. Then we have Meta, Amazon, Google, Microsoft, and Apple. And then on top of that, February tends to not be the best month for tech stocks. So it's going to be really interesting to see how these companies give guidance, because that's going to determine what happens. March, we're likely not getting the rate cut. So it's going to be interesting. How do they give guidance? How are we going to go into March? What's the CPI data, which we're going to get in about 2 weeks? And then what does Jerome Powell say? A lot of stuff going on. And so we'll be discussing all that stuff in the next couple of days. And PayPal's on Thursday. There you go. And PayPal's on Thursday. All right. Thank you, everybody. Appreciate it. I will see you guys today for the market open, 3:45, and then 5 p.m. We'll have Dan Ives. So we'll have 2 streams later in the day. Thank you, everybody, for being here. Congrats to everybody on SoFi. And yeah, see you a little bit later. You got to outdress Dan. Yo, thank you. I gotta wear a better shirt than Dan today. I'm going to come in with a crazy outfit. I'm going to have a crazy blazer, crazy. I wasn't even thinking of outdressing Dan. So Adam, thank you for saying that. Because, and Bot, you said wear a green shirt. I have to wear a crazy shirt and outfit to outdo Dan. I can't just wear this basic polo today. That'll be fun. All right, everybody. See you guys later today. Have a good one. Bye-bye.